Good morning, everyone, and thank you for attending this webinar. We are wanting to start out with some housekeeping items, as we typically do. You can see them listed here on the screen. The one that I want to make sure is emphasized, because it's not fully explained on the screen. When you use the chat function, please address your questions to all panelists. We have one of our presenters that's monitoring the chat function for purposes of presenting questions to the various presenters. So just remember on that last bullet, when you provide a question, provide it to all panelists. As you look at the material, the third bullet from the bottom, we will have a series of polling questions. Those of you that are not familiar with continuing professional education credit for CPAs, that is the method that is required for us to provide CPE in a webinar environment. Those of you that are not requesting CPE credit do not need to answer the polling questions, but you are certainly welcome to do so. So with that, let's begin the presentation. Jordan. Left page and down. One minor technical difficulty being addressed.
I'll handle it for you.
Okay. Next slide. So, just the typical disclaimer, we want you to consult with both legal counsel and your independent accountants with respect to matters that we are discussing here today. As you all know, this situation is very fluid and things change on a frequent basis. So we can't necessarily take this presentation as gospel on a going forward basis. Next slide. So over the last 45 years, and I'm not going to read this slide to you, but I think it's important that you know, we prepared this presentation with over 100 slides so that you could provide it, and in my opinion, you should provide the entire slide deck to your senior management team and, if appropriate, to your board leadership on Monday or by end of day Monday. If you want to wait until after the holidays, that's fine. But the amount of challenges that providers face at all levels of management, I think, are very well summarized in the various presentations that you will see today. I put this slide in because it came from a presentation I did in October of 2019. And at the end of that first paragraph, it says, as with other industry transformations, it will be driven by consumer choice, financial decision-making, and an external force yet to be identified. I did not predict COVID-19 in any way, shape, or form. I'm not suggesting that. But you will be incurring and you will be considering fundamental changes in many of the aspects of how you were operating prior to COVID versus what will be described and has been described as the new normal after we get through the pandemic. So we've got two versions of the topical agenda here. One, the one I'm going to go through is the overview of what we're going to talk about and who's going to be doing the presenting. Again, I'm not going to read it to you, but what I want to say on these slides is that this is the most challenging year in my 47-year career for management, finance personnel, and independent auditors. So the CPAs that are on the call, whether you're on the client side or the provider side, or whether you're in the practice of public accounting and auditing, this year end, December 31 of 20, and some of what you'll hear today will reinforce this for you, I believe has the most complicated set of revenue recognition issues, lack of clarity, certain amount of confusion and miscommunication. So it's very important that we've started our 3-seminar series here with this particular set of topics, because it does provide those of you on the phone with at least a baseline And we strongly encourage everyone on the provider side to engage with your independent auditors and have discussions on the topics that are applicable to your organization prior to you closing the books. So if you're a December 31 year end, you've basically got until the end of January, but I believe a direct communication between you, the CFO, finance staff, and doesn't hurt to have the CEO on the phone either, would be a very appropriate step. Next slide. So some of the areas here, this one with respect to double dipping and clawbacks, we've been talking about this for the last several months, and we introduced it, I think, at our October 30th webinar. We are not going to have a really clear picture. We do have some new information, or relatively new information for you today. But as you know, the Congress is debating today and is trying to pass by tonight the next stimulus bill, which looks like it's going to be somewhere around $900 billion. It looks like it's not going to include any support for state and local governments. And I think it's important for you to know that at Wednesday's Cuomo briefing, he mentioned that there are a number of people in Washington that are opposed to any state or local funding through the stimulus. And he had it on the slide, the states should declare bankruptcy. So he's mentioned bankruptcy now probably a half a dozen times in his daily briefings. I don't believe that until Biden takes office that we will have really a clear picture on whether or not New York State will be getting the 15 to 20 billion that is needed for this year, and he's asked for 20 billion for 22-23 and 23-24. And then I'll be back at the end of this presentation relative to the status on those stimulus negotiations and what might be the outcome if we get a stimulus bill before Christmas, which they say they're staying until they pass something. So we're going to get something. That will become part of our January 29th webinar that we already have scheduled and sent out to save the date. And there's a slide here that will give you that information. Next slide. These next several slides basically, again, for purposes of distribution to senior management and your board leadership, if you give this slide deck either in whole or in part, but preferably in whole, they can flip through it and they can see the detailed descriptions of the topical presentations and the number of issues that I referred to earlier as to the most difficult situation that I've ever experienced in my career relative to closing a set of books and making sure that things that are needing to be recorded are being recorded properly. So, next slide. I would mention that information technology, many of you have heard that we're through an epidemic, particularly in the nonprofit sector, not the pandemic, but the epidemic in the nonprofit sector of criminal elements and folks that do not want to necessarily help you in the IT area, trying to breach your networks, and install ransomware and other issues. So we have a brief presentation today with respect to IT and cybersecurity. Next slide. So the other item that is new today versus what we presented in the past, Andrea Hagen will be discussing third-party and Medicaid billing issues. On this particular issue, I think it's important for you all to know that surprisingly to us and shocking to me, one of our clients has received a letter, email I should say, from OPWDD asking for a series of information and the possibility of an audit of how they handled the retainer day program changes and related billing. That same client received an email from OMIG indicating that they had been selected for what's called a PERM audit, Perm Audits. I'll talk about this later as I come back at the end of the presentation. Perm Audits have been around since the year 2011-12 timeframe, issued by the folks at CMS. The individuals at the state agencies, particularly OMIG, have not necessarily emphasized the audits that they've been doing as Perm Audits, but they appear to be getting pressure now to satisfy the federal government in terms of completion of audits as instructed by CMS. Paul Mayer is going to describe what we expect to happen by the end of April. The law has already been changed this past April to allow for regulatory compliance and compliance officers to be outsourced to an outside vendor, and it no longer needs to be an employee of the organization. Obviously, you have to have somebody in the employee of the organization that's responsible for compliance, but the compliance officer position, hopefully in the next several months, will be clarified so that it can be outsourced to another outside party. Next slide. So we want to make sure you emphasize your questions throughout the presentation. Depending upon the timeline, we'll do the questions for each presenter, or we may do the questions in that 2 to 2:30 time frame. Next slide. All right, so just to kind of set the foundation for Jeff Paley and Margaret Lally, our first presenters, I put together this list of questions. Again, keep in mind, this is designed to be provided to your board and your management team. Next slide. And I believe that the objectives that are stated here are in accordance with what I've presented so far. And the last bullet, again, to reinforce, it is possible that your 2020 financial statements may involve more accounting estimates and judgment decisions than most, if any, previous audit processes. So that's something that has to be clearly presented to your board, because they're aware of the typical estimates on depreciation and bad debt reserves and those kinds of things. But we've got probably, depending upon your situation, anywhere from 3 to 6 other decisions that are going to need to be made relative to estimates and decisions. So the summary comments here that we are attempting to answer are listed on this slide. How do providers properly account for the PPP loan expenditures, forgiveness, and the HHS PRF funds, as well as other stimulus funds that are going to be received, may have already been received. Those providers subject to single audit under uniform guidance, the threshold obviously is right now at $750,000. What preparatory and planning action should be taken now with respect to your documentation requirements? When, and this one we're not going to answer today, when will we have more clarity and guidance with respect to the questions? On the Provider Relief Fund website for HHS, there are close to 250 frequently asked questions. On the Department of Treasury website, there are more than 50 frequently asked questions. In some cases, you have to be careful that a frequently asked question that might be number 222 may or may not be referencing back to a previous FAQ. So you want to be very careful in interpreting those questions. And that's why I believe that every provider, there is no single provider, in my opinion, other than folks that are over $100 million in revenue, that can possibly keep track of all of the issues associated with COVID-19 and the related stimulus activities, changes in regulations, et cetera, without consulting with your outside advisors. Our firm has close to 30 people that have been dedicated to various aspects of this particular situation that's now going on. Well, today I think it's this week is month 10, if you will. So, last two, go ahead. I'm sorry. How do providers prepare and maintain adequate documentation with respect to all of the audit processes? Again, I just mentioned OMIG and OPWDD. This is surprising to me that they would come out with these requests for audits in midst of the pandemic. So we don't know where it's going, and it just happened within the week. So we're going to try and find out more, and we can certainly report more back to you at the next webinar. And then the final point, which I'll discuss at the end of the presentation, would be strategies to maintain, that should say financial viability, not liability, financial liability and operating performance, instead of positions, sorry about that, viability and performance for purposes of getting to the other side. And then finally, the next slide, I mentioned it a couple of times, we will be doing our next webinar on January 29th, and we certainly appreciate that more than 400 folks registered for this particular session. And that bolded item on the bottom of this slide, we're approaching $80 billion in Medicaid spending. Many of you are reliant on Medicaid for more than 50, in some cases more than 80 or 90% of your revenue. And Governor Cuomo said on Wednesday at his briefing that he would likely, didn't say for sure, because he doesn't know what the state's going to get in terms of stimulus, he may defer his release of his budget, which is usually done on or about January 15th for legislative discussion and debate. He may delay until February or even March after the Biden stimulus is determined before he actually puts a budget on the table. If he puts a budget together now with a $15 billion gap, the entire industry or service sectors that are represented, health, human services, as well as others funded by state dollars, are not going to be pleased with the types of cuts that he would have to provide. He also mentioned on Wednesday that he is going to raise taxes. Didn't say in what areas. Again, I believe that he can raise a fair amount of money in the sin tax area, if you will, that being the cigarette arena. If we go to recreational marijuana, there's a fair amount of dollars there in taxes. And gas has been consistently down in the low 2s in most of the state. So I think you're going to see a combination of incremental taxes, both in some of those areas as well as income taxes, focused mostly on wealthy individuals in New York State. So before we turn it over to Jeff Paley and Margaret Lally, we do have a polling question for those of you that are looking for CPE for today's discussion, or today's webinar. And the poll question appears on the right side of the screen. And the question is, who won the election? Joseph Biden or Donald Trump? Again, there are no right or wrong answers. You're not going to be evaluated on these answers, but we want to make sure that those of you looking for CPE are, in fact, if you will, making sure that you're attending throughout the 3-hour session. That polling question will close in
48 seconds.
48 seconds. So we're going to go on. It's not a difficult question to answer, so you should have answered it already.
It might be a trick question.
It is a trick question for some of you, I know.
But the way Biden spelled.
But at this point, I will, but Biden is B-I-D-E-N, by the way. I will turn it over to Jeff Paley and Margaret Lally for our section on financial reporting considerations, disclosures, and all the various stimulus issues that are created through PPP, Provider Relief Fund, et cetera. So, Jeff?
Thanks, Arch. Thanks, everybody, for being here. Coincidentally, we're going to kick off this next section. We're going to be talking about PPP loans, but we're going to kick it off with polling question number 2. So, since you just found the spot where you reply to the polling question, refer to that spot again, and we're going to launch the next question to kick off our PPP discussion.
Do you want me to announce it?
No, I can do that. So the question is, your status related to PPP loan is best described as follows. Fully forgiven with SBA approval, forgiveness applied for, but approval not received yet, ready to apply, but waiting. Forgiveness calculation is in progress, haven't started yet, or I don't have a PPP loan, what's the big fuss? Again, there's no right or wrong answer. And you do have to reply to get your CPE credits, but also we're a little curious where people stand on this, so please give us your honest assessment.
$30 seconds.
30 seconds. You can make sure to get clicked in if you want your CPE credit we're happy to provide it, but we have to follow the rules of making sure you're engaged.
We got 220, and just for anyone else, you got 10 seconds.
Again, those of you that are not looking for CPE do not need to answer these questions, but we certainly appreciate it if you would. If you feel so inclined.
All right, poll is closed. That actually shares those results.
Okay, so we have a fair proportion who don't have a PPP loan, which is fair, and then a pretty good spread in terms of the status. This is actually kind of what I expected to see. Because of the way these PPP forgivenesses are being processed, we are seeing organizations in all different stages of this process. So what we're going to go through here is some of the higher level, most common concerns and issues that have arisen as people are going through and trying to finalize or at least strategize around their forgiveness. The first one talks about eligibility, and people say, well, why are we talking about eligibility? I got my loan back in April. Obviously, I'm eligible if they gave me the money. That assumption is a little bit dangerous. There was a lot of confusion back in April about how this was rolling out, and we know, and we've seen in practice, there are organizations who may not actually meet the eligibility requirements who got a loan anyway. So now, as we're strategizing around forgiveness, we're talking about eligibility in a whole new way. We want to bring this to your attention. So there's really four things where we're seeing people have stress or opportunities to better document their eligibility. The first one is if you have more than 500 employees, you may not meet the definition of the SBA's, the definition of a small business. There are ways to make yourself eligible even if you do have over 500 employees. The primary way is that you operate in a specific industry where the limit is higher than 500. This is a challenge sometimes because the SBA actually has defined criteria to determining what your primary industry is. So applying an industry code that does not meet the SBA's definition of what your primary industry code is carries some risk. Documentation around how you concluded that you're eligible is very important. The second one is about these affiliation rules. There are organizations who have multiple corporate entities. None of them individually have over 500 employees, but when you put them all together, they do have over 500 employees. The SBA rules are looking at the affiliated group together. So there's the thought that if you applied individually for your multiple entities, and they're each under 500, you're fine. That may not necessarily be true. And again, I'm not here to tell you that you're not eligible. I'm here to tell you that you need to document how you got to your eligibility conclusion if that fact pattern is familiar to your organization. The third one is if you have an affiliation with a governmental organization. Governmental organizations were not eligible for PPP, and if you are a nonprofit who happens to have an affiliation with a governmental organization, documenting what that affiliation is and how you remain eligible in spite of that affiliation is important, and we're strongly recommending that you document that and think about it, again, before you apply for forgiveness. And then the last one, and this may seem a little more obvious, but we've seen it, organizations a nonprofit to be eligible for PPP has to be a 501c3, a 501c19, or certain tribal organizations. If you're exempt under a different part of 501c3, you definitely have an eligibility question if you got a PPP loan, and we know that organizations in that category did get PPP loans. Again, the purpose of pointing this out to you today is that if you're thinking about applying for forgiveness or you're just about ready to pull the trigger on your forgiveness application, if any of these things apply to you, we're recommending that you do not apply for forgiveness until you have thought through your eligibility questions on these four topics and documented your eligibility effectively so that when questions come back, or if questions come back, you're prepared to answer those questions about eligibility. Can I go to the next slide? So the forgiveness calculation, hopefully everyone who has a PPP loan is familiar with this now. There's really two pieces to this. Did you spend the money on eligible expenditures? That is typically not the challenge because the time frame got expanded to 24 weeks. Most organizations have spent adequate amounts to cover that. The second part of the calculation is, did you maintain your FTE levels, or did you qualify for safe harbor from the FTE calculation? The safe harbors, there's really two of them. Were you shut down, or did you have your activities curtailed because of a mandated government shutdown? Or did you reduce your FTEs at some point and then restore them to their pre-COVID levels at some point later in the year? Both of those things have some complexity to them, and they both require documentation to support your position that you qualify for that safe harbor. Many organizations do, especially depending on what state you're in and what locality you were in terms of these government shutdowns. A lot of organizations are able to qualify for the safe harbor, and they don't have to calculate the FTE calculations part of the forgiveness calculation. There are some complications here in terms of, did you reduce anyone's hours or pay by 25% or more, and other elements that factor into both parts of that calculation that create some complexity. Our advice is to, as you get into those more complex areas, please seek out advice from your lender or from another professional who you trust. These things do get complicated, and you're only doing it one time, whereas, like here at Bonadio, and I'm sure at other providers, we're helping hundreds of organizations with these. So we've probably seen your situation before, and helping advise you on those things is something that we're doing literally on a daily basis. John? The next slide, I'm sorry. The Loan Necessity Questionnaire. This came out more recently, later in the year. If you're a nonprofit, you're going to be asked to fill out Form 3510. If your loan is over $2 million, it's required to fill this out. This has caused a significant amount of concern, and we're actually seeing more concern at the governance level on this. Because boards are saying, do we really have a necessity to take this loan and take this forgiveness if we also have assets or other resources on our balance sheet that we could have used? And how closely is the SBA going to judge this in terms of, if we have a balance sheet that shows, let's say, unrestricted investments or available cash or even an available line of credit balance, are we going to be criticized for taking the SBA loan while we had this other source of liquidity at the time? We don't know right now what the SBA is going to do with this information. We know that they're collecting it, and that, especially for the loans over $2 million, they have said they're going to audit these loans in some way, shape, or form in the future. We don't actually know what they're going to do with this information. So we are advising PPP borrowers who are over $2 million to be honest, of course, with their responses to these questions, but also to think about positioning and tone of how you answer these questions in the context of responding to this assertion that you made when you applied for the loan, which is in quotes in the third bullet. Current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. You certified to that when you applied for the loan back in April, and the SBA is collecting this data to evaluate whether that assertion that you made back then was appropriate. We don't know any more details beyond in terms of what the SBA is going to do with this information, but it's certainly important to have. We also think that for loans under $2 million, this is informative to you, because the SBA has not said that they're not going to review loans under $2 million. It's possible they could. So if you're thinking about this and your loan's under $2 million, look at the Form 3510, or if you're a for-profit company, the 3509, and understand what kind of data the SBA is looking at when they're making this, what they're trying to gather related to making this determination. Next slide. So we talked about GAAP accounting. There's a lot of questions about accounting. And part of the reason is that as the accounting profession, we've given you a lot of options, unprecedented flexibility in some cases. There's really two main paths here that companies are taking. The debt model, most for-profits are following the debt model, and the debt model basically says this thing is a loan until it is formally forgiven. So it's a liability, interest at 1%, until you get the forgiveness approval. The other one is this government grant model that says it's a refundable advance, and you can record the revenue as you meet the conditions to earn forgiveness. Whether you have formally received forgiveness or not is not the relevant measure in terms of the accounting decision. Most nonprofits are following that path. But in the generally accepted accounting principles, you do not have to follow one or the other based on whether you're a nonprofit or a for-profit. There's a lot of flexibility in terms of how you can account for this. That raises a lot of questions in terms of what's the best path for my organization to take. So if we go to the next slide. Oh, it's a polling question. So let's launch the third polling question. And this one is your organization's status related to accounting for your PPP loan is as follows. You've chosen the debt path. You've chosen the grant path. Just heard about this. Didn't know I had a choice. Or you're still thinking about it or waiting to see how the year comes out so you can manage your bottom line results for 2020. And we do not know who's answering what answer, so we cannot incriminate yourself by answering number 4 or D if it happens to be the case for your organization. So while you're weighing in on that, we do have some considerations related to reporting considerations. This flexibility in the gap does create this opportunity for what we call earnings management. And if I put my auditor hat on, and I think the auditors on the call would agree, earnings management opportunities is not something we particularly like as auditors, because what it really means is that management has a choice of what kind of surplus or deficit you're going to show for the year based on what election you make for this accounting decision about the PPP forgiveness. Either way, whatever choice you make, you should have, we strongly recommend you have discussions with your auditor in advance. Again, as Art said, before you close the books on 2020, talk through some of this stuff with your auditors. There's also going to have to be footnote disclosures to the extent you're doing a GAAP audited financial statement that include the terms and elements of this and some of the risks and contingencies related to the potential for future SBA review. The one thing we know at this point about the single audit is good news, is that PPP funds are not included in single audit requirements and should not be on your schedule of federal awards. If there's one nugget of good news here, that's it. I'm sorry, did we finish the poll? I skipped ahead.
Yes, we did finish the poll.
Thank you. So on the PPP loans, we have this concept of the double dip. We have a whole section later in this seminar about the double dip, but this is really the theory that if you have $1 of expenditure, you can't apply that dollar to support multiple sources of revenue. And what this really comes down to is you can't consider just your PPP forgiveness in a bubble. You have to think about your PPP forgiveness in relation to all the other funding you may have, whether that's other CARES Act funding, other COVID-19 relief type funding, or just your recurring funding that happens on a regular basis, even when we're not in a pandemic. The considerations here can get quite complicated, and like I said, we're going to talk about that in more detail later, but the point is, don't just move forward with your PPP forgiveness until you've thought about how that interacts with your other funding streams, where there could be opportunities to maximize revenue by strategizing them together, not as individual streams. Next slide. We know you're asking questions. We're going to get to those as we go through our time together. And now I'm going to turn it over to Margaret.
Hi, I'm Margaret Lally. I'm a manager here at the Bonadio Group, and I'll be talking about the Provider Relief Fund today. So this first slide just kind of gives you an overview of all the funds that have been released thus far. They generally fall into 2 categories, general distributions and targeted distributions. So you can see the timeline and the different types of providers that were included. We have just found out within the last couple of days that the Phase 3 add-on payment is starting to be distributed, and they've given a little clarification on how they came up with that. So if you applied for Phase 3 funding, part of the application required that you report your patient-related revenue and expense for the first 2 quarters of both 2019 and 2020. And HHS then calculated the change in your net income over the 2 years and provided 88% of that reduction in net income, if you had a reduction, less whatever amount you received previously. Now, we haven't figured out yet whether they took out just the general distributions from that or the targeted. My feeling is that they probably just removed general distributions received to date. But in any case, a lot of our clients, this is a very substantial add-on payment. So they're going to be distributing those add-ons on a rolling basis starting a couple days ago and moving throughout January. So this slide, kind of exemplifies our frustration as accountants, and I'm sure your frustration as providers, in the sense that the guidance and FAQ for the Provider Relief Fund has been very fluid and constantly changing. So you can see on the timeline, here's just a few of the items that have been changing. As Arch said earlier, there's over 250 FAQs. The document is about 58 pages. And additionally, on the website, there's several different tabs with additional guidance that don't appear in the FAQ. So you really have to look at the whole website and the whole FAQ as kind of a whole document. Another frustrating point is that, generally speaking, they don't always update previous FAQs when they release new ones. So like I said, you really need to look at the document as a whole, because if you are searching through it and find what you think is the answer to your question, it might be superseded later on in the document by another entry. So I would definitely suggest that you, have someone on your team that really spends a lot of time on this, or have somebody that you trust that you can reach out to ask specific questions, because it is really difficult to keep track of all of this information. So the one thing I do want to note that has not changed is the terms and conditions that you attested to when you accepted the money. So there's two ways to attest. Either you proactively attested by signing on to the portal and going through the DocuSign process, but HHS also considers that if you've kept the money for more than 90 days and have not attested, they implicitly assume that you're agreeing to the terms and conditions. So I think as you get into the weeds of looking at whether you've met the conditions for the money and therefore can recognize revenue and keep it, these terms and conditions kind of provide a North Star. They're general, but if you're getting into a complex question, if you kind of circle back to these and look at really the intent of the funds, you may find yourself with an answer. So if you've received funds, you have to certify that you provide or provided after January 31st diagnosis, testing, or care for individuals with possible or actual cases of COVID. Now, it's important to note that HHS considers all people possible cases of COVID. And this makes sense because, even if you don't have anybody in your business that has COVID, you've certainly had to make all sorts of changes to how you do business in anticipation that there might be somebody with COVID. So you've had to buy PPE. You've had to make changes to your facility to comply with social distancing and those kinds of things. So they recognize that even if you haven't had anyone that actually had it, you've had to make a lot of changes, and those cost money. So the Provider Relief Fund payments are only to be used to prevent, prepare for, and respond to the coronavirus. And you can't, going back to what Jeff said with the double dip, you can't use the money for something that you've already been reimbursed by someone else, or that someone else is obligated to reimburse you. It is important to note, if we have any skilled nursing facilities on the call, the infection control payment that was issued in August, as well as the currently being distributed performance-based payments, have separate terms and conditions. So they're not, those have not been released yet. And so, you're going to be held to different standards for those funds. This slide provides kind of an overview of the reporting process. So if you got less than 10,000, you're off the hook. You don't have to report. If you got under 500,000 but more than 10,000, you have aggregated expense reporting. 500,000 or more means that you need to do detailed expense reporting. And then if you got more than 750,000 in aggregate federal funds, excluding PPP, you're going to be subject to a single audit. Right now, I've got the key dates listed here for you. January 15th of 2021, the reporting portal is scheduled to open. I will say that most of the deadlines to this point have been extended, and given that HHS was promising webinars and additional guidance in terms of how their definitions for reporting that we'll go over in a couple minutes, that has not happened. And, with the holidays coming, I find it, I'll find it surprising if they're able to put that stuff out within, we're less than a month away from that portal opening. So, I'm kind of hoping that they extend it, because I do think that there's still a lot of confusion around the reporting requirements that needs to be clarified. Additionally, I'm imagining that providers are going to be pushing back, given that, you just will have finished your year end, you're ramping up for audit. There's a lot going on. HHS to date has been extremely responsive to both association pushback, provider pushback, and so I'm thinking that they're probably hearing a lot of these things. But as of right now, the portal will open January 15th, and it will close on February 15th. And that's the reporting period for any money that you spent during 2020. So you do have at this point up until June 30th of 2021 to spend all of the money. So if you haven't spent it yet, you still have an additional 6 months next year to spend it. And again, given the ongoing nature of the pandemic, we could see that extend as well. And then as of right now, there's going to be a final reporting period on July 31st. It's important to note, too, that if you do spend money in 2021, it's going to be compared to the 2019 base year and not 2020. So HHS has kind of listed in their reporting requirements a two-step process for how to determine whether you've used your funds and how to use your funds. But as we were looking at it, really that first step is kind of broken down into two pieces. So we went with the 1A, 1B approach. So first you're gonna look at all of your expenses that are attributable to coronavirus. You're going to remove from that any reimbursement that you've gotten from other sources for those expenses. And then additionally, you're going to apply your lost revenue. So this slide here, it's a little bit busy, but it is color-coded to the last slide, and it really kind of details out all of the things that you can use. So I also want to note the new guidance at the bottom. This is, again, ever-changing, fluid, and so this is what we know at this point, but it very well could change. So expenses attributable to coronavirus are broken down into general and administrative expenses and healthcare-related expenses. The healthcare-related expenses are pretty straightforward. Those are the incremental costs, PPE, any kind of additional equipment that you had to buy, information technology to support either telehealth or work from home type situations, any modifications you made to your facilities in order to promote social distancing or other things to prevent transmission. And one new item that they put out that's very great for providers. Initially, if you'd had any capital purchases, I know a couple providers have bought, for example, new vans because their old vans couldn't hold as many people while maintaining the 6 feet social distance requirement. And so initially, they were only going to let you take that annual depreciation on those capital purchases. Well, given the pushback, they recently came out and said if you can tie those capital purchases directly to COVID, you can apply the funds to the whole purchase price expense of those purchases. And this is great news too, because if you do end up in a situation where you have money that you think you're going to have to pay back, it might be a good opportunity to strategically look at some purchases that you might make that would be great long-term for your operations, but also enable you to use this provider relief fund. The general and administrative costs are a little bit of a gray area right now. A lot of the new FAQs that have come out really talk about incremental fixed costs, so things that you didn't have in a pre-COVID world that you do have now. But the reporting requirements supplement section of the website lists out mortgage rent, insurance, personnel, utilities, and the other items that have been listed here, as well as the phrase maintaining delivery capacity. Now, I think that most providers would look pretty much at all of their operating expenses and say that they're all necessary to maintain delivery capacity. So this is one of the questions I know HFMA as well as other associations have out to HHS right now to say, what does that mean? What can we include and what can't we include? This is really not clear. So we're definitely hoping for clarification on that. In the center column, we have amounts reimbursed from other sources. So you can kind of go down and see what kinds of reimbursement streams you're going to have to back out when you're calculating your expenses. And then lost revenue is also another thing that you can apply against your funds. So this would be the difference between your 2020 and 2019 calendar year patient care revenue, net of bad debt. You are allowed to include 340B revenue. And you do want to make sure it's an apples to apples comparison. So you're going to remove any kind of settlements or one-time amounts that you received that aren't related to those years. So if you have like retro adjustments or things like that that are not related to 2019 or 2020, you can back those out of your calculation. Now, I just wanted to end the presentation today by talking about a couple of new things that have come down the pipe. So in addition to the phase 3 rollout of the add-on payments, there is additional funding for the Provider Relief Fund being discussed as part of the new stimulus package. So the most recent language added an additional $35 billion to Provider Relief Funds, and it also changed the lost revenue definition to include any reasonable method to calculate lost revenue. And I think this is probably in response to providers who, for example, launched a new service line in 2020, or maybe they closed down a service line. And so their revenue year over year really isn't comparable. And they may want to use something like their budget or, revenue from a similar type of service line to compare year over year so that they can really hone in on what the change related to COVID was. The other thing I want to point out is that Biden has announced that he's picking Xavier Becerra to be the new head of HHS in the new administration. And he is currently the Attorney General in California. So a lot of experts are predicting that there is going to be, significant enforcement of these terms and conditions. So I would say documentation is key. You need to make sure that you're isolating all of these items and clearly documenting how they relate to COVID and how you're going to use them to apply to your provider relief. So again, you can feel free to submit any questions through the chat to all panelists, and we will try to get to those today. And with that, I'm going to turn it over to Mike Ballmer and John Miller.
Thank you very much. For those that do not know me, I'm Jonathan Miller, a partner with the Bonadio Group. And today we're going to take a little bit of a break for some of this technical reporting on these CARES Act funds, and we get to talk about the exciting topic of the financial reporting matters that this is creating. As Jerry mentioned in the beginning, even these financial reporting matters have uncertainty to them. So what Mike and I are going to cover is really what some of the principles are related to the financial reporting, and we don't have enough time to get into detail because all these bullet points are probably a half-hour conversation, but we want to provide you with the 50,000-foot level view where the principles-based considerations are coming from, just so you can start thinking about some of the discussions at year-end that you're going to need to have. So what we'll do is, if we get to the next slide, is looking at the financial reporting matters and what's the principal accounting model for the CARES Act. So you might have heard us in the October webinar or other webinars we've had or others. Really, when you look at CARES Act funds, that's a government grant. And the accounting guidance specifies in ASC 958-605, I know that's a technical term, but that's your grant and a guidance, grants and contracts accounting guidance. In there, it says government grants follows this accounting. And so what it says is if you are following this guidance, you must defer recognition until grantor's conditions have been substantially met. And I put that in bold because that's a key term to be thinking about as we level set what the accounting rules say. The other piece of it says is the probability of meeting those conditions cannot be considered. So it's not like 80%, we think we'll get there. Well, I can control this, and I really believe that we'll recognize all this. You can't consider that. And I know those two items, when you think about it, what those do is they set the baseline, but also they're kind of very, what I would say, harsh in terms of, geez, Margaret and Jeff just went over all these different accounting treatments. We see that the provider relief fund is changing. Terry and Mike are going to talk a little bit too about the CFR impact. What do you mean the probability is either binary, 0 or 1? Again, that is what our starting point is. And what you see is the next bullet is the recognition in income. So when the conditions are substantially met is when you'll bring it into income. Again, this is our starting point. But what that's saying is if you have not met those conditions, it's what's called in the accounting literature, a refundable advance, but I would think about that as a liability. So as we go to the next slide, and we start saying, okay, let's build upon this concept. Well, the grants and contracts accounting guidance does not really get into estimations. It's either all or nothing, as I just said. But a lot of this provider relief, this PPP, and a lot of this CARES Act money is very unique. So now we have unique circumstances. And we need to say, is there something else in the accounting guidance that we should be looking for? And what we can do is we can go to ASC 606, revenue recognition. So I'm sure some of you are at least familiar with, you implemented the revenue recognition standards last year. There's a 5-step process. But as part of that process, you're allowed to consider variable revenue recognition considerations. And what that means is essentially you can estimate. So if we analogize 605 to 606, that provides us a path to estimation. So you see some of these 3 bullets here. They talk about constraints, forward-looking information, and future activities. This is what's providing you the opportunity to estimate. So what are some of those constraints? Well, we know as recently as today, the Senate is working on an additional bill to provide stimulus. Could some of that be changing the provider relief fund, as Margaret alluded to? There might be changes in it. What about this risk of double dipping? In terms of I have one expense here, I have another expense from CARES Act. Who do I know is going to cover each one? And I can see some of the questions coming in. Margaret said revenue of last. She said you need to use the revenue that's already been provided, not reimbursed from other sources. The questions coming in are, I can see what revenue from other sources. Those are things you might not know right now. So that's kind of where the estimating constraint is coming from. Because really, we all know that you did have eligible expenses. There's at least something in that bucket that's eligible. There's probably a little bit you're not sure about. And looking at 606 and analogizing it is where you can start the estimation. So then the next slide, we've had a couple questions come in from our clients about operating versus non-operating. So it just took a minute to put this in the slide. I look at it as what is the relationship to this CARES Act funds to your ongoing operations? Did it cover operating expenses or even what your lost revenue was that would have been in operations? And typically I would think that's going to fall into your operating. Of course, some of you could come to different facts and circumstances or have different reasons to say it's non-operating. That's okay. That's a matter of you documenting it. And then I also think it's important to talk about subsequent events because this is going to help us in terms of what you record as of your 1231, especially as times are changing. So again, we level set some of these definitions. I think it's important to know what the guidance is on subsequent events. There's 2 types of subsequent events. There's the type 1, which is you recognize those subsequent events in your financial statements in this case, as a calendar year and 12/31/20. So type 1 is events or transactions that provide additional evidence about conditions that existed at the date of the balance sheet, including the estimates inherent in the process of preparing financial statements. And then type 2 is non-recognized subsequent events. So these will not end up being recorded in your balance sheet. But those are events that provide evidence about conditions that did not exist as of the date of the balance sheet. So when we think about this and say, okay, what have we learned over the last year about whether it's type 1 or type 2? So, especially for a lot of you calendar year ends that hadn't completed your financial statements by March and April when the pandemic hit, if you'll recall, more than likely, you had a subsequent event footnote that said there was a global health pandemic and CARES Act funds have been released. So those were events that happened after your balance sheet date, and they were disclosed as a Type 2. And now as we kind of think about, okay, what's happened with the provider relief funds, and we've seen changes related to that. We've seen the PPP, and, that's gone from 8 to 24 weeks to even questions that are still arising. How does that fit into subsequent event guidance? So what we saw with the fiscal year-end providers, the 6/30 year-ends, they knew that there was provider relief funds out there, but as of that date, they didn't know exactly how much was allocated to them. The calculation hadn't been performed. So that was not what's called a known circumstance. So what we saw was the AICPA and a lot of the Big Four told the providers they were working with, you don't need to recalibrate your balance sheet because that event wasn't known. So it became a Type 2 subsequent event. As you work through, Margaret mentioned, we saw the September 19th, the loss revenue calculation changed, and October 22nd it changed again, and now we know it's in the stimulus bill that it could change for a third time, reset all the way back to that. We have to consider, as of 12/31, will we know exactly what it is, or, and is it Type 1 or Type 2? If this bill is completed by 12/31, we'll actually know what that calculation is. So does that become Type 1 that's going to affect your balance sheet? You can kind of see where I'm going to in terms of facts and circumstances. And how I think about it is, again, I keep going back to what was known at 12/31 that you got an additional piece of information about. That to me is Type 1 should be reflected in the balance sheet versus what's not known and you got additional information about that should be disclosed.
So 20% with payment withhold from New York State contracts. If you're on this webinar, you are well aware of what's happening. The governor in July of 2020 announced that there would be this 20% withhold. Could it stay? Could it go? Well, the biggest question right now is if there is a new stimulus package, will it have funding for states and local governments? And if it does, there's a good chance that this slide is kind of a moot point come that time, because we may not have this 20% withhold become a reality as far as a actual cut. But with New York State being 15 to 20-ish billion dollars in the hole for this year, if that funding does not ever come through, it is very likely, I think, that we will not ever receive this 20% that is being withheld. So on the accounting side of that, there's really two ways that this could go. Is it an exchange transaction or is it a non-exchange transaction? If it's an exchange transaction, it goes back to what John was just talking about with ASC 606, the revenue recognition concept. And what's the transaction price? Is there variability in that? And you need to examine that. So generally speaking, if you are going to follow 606, revenue recognition, if you believe this is an exchange transaction, you're going to be recording the revenue, and if you don't believe that revenue is any good, instead of recording a bad debt expense, you'll essentially reduce your revenue for that bad debt amount. So you just won't recognize the revenue for the bad debt. And it's not totally dissimilar in thought pattern to the other side, a non-exchange following 605, the grants and contributions concept, where you would recognize the revenue and then you'd have an allowance and bad debt expense against that. So it all comes down to how are your contracts written? Are they following 606? Is it following 605? For those of you who have implemented the revenue recognition ASC so far, you know this answer. You've already looked at those contracts. For those of you that haven't, you're going to have to potentially think about it when it comes down to it. We fully expect that there's going to be organizations going both ways. There's going to be grants and contracts that are going either way. So we will have some that will be showing an allowance, some that will just be reducing revenue. And on the exchange or the non-exchange transaction, or either side, you may determine that that receivable is good. You may determine that receivable is not any good, That's a judgment call that you have to make. We, of course, encourage you to have that discussion with your CPA, with your independent auditor, and make sure that they're on board with your thought pattern on that. I won't really spend much time on this, but this kind of gives you a few steps in determining, is this an exchange transaction? Is this a non-exchange transaction? And how you kind of go through the process of determining that and what you do in each of those cases. So we focused a lot on PPP and PRF up to this point, the Provider Relief Fund. There's several other CARES Act programs and non-CARES Act programs that we haven't really touched on at all. And I feel as though having one slide dedicated to a number of these things is doing a little bit of disservice, but some of it's not overly difficult from a financial reporting standpoint. So if you deferred payroll taxes, you have to be recognizing that liability at the end of the calendar year or of your fiscal year. The consideration is whether that's current or long-term. So you have half of that amount due in December 2021. If you're a calendar year end, that would be a current portion. And half is due in 2022. Obviously, that would be then a long-term portion. Many of you may have received employee retention tax credits. That should be recognized as other income in your financial reporting. Many of you are self-insured, reimbursing employers, and you have a 50% unemployment credit. You may or may not even know that you do. The state has been bombarded, of course, with unemployment claims, and I think that they've had a very hard time getting this information out properly and timely, and the implementation of all this. Essentially, if you paid all of your unemployment bills 100% in your second and third quarters, you should have a 50% credit for those amounts that you paid going forward. That should be recorded as a current asset, assuming that it's probably going to be used up, so to speak, in 2021. You could account for it as an account receivable or as a prepaid. We think that prepaid is probably the most appropriate and preferred method of doing that. You could make a determination a different way. And then other is kind of broad, right? We have Fcc grants, we have FEMA grants that many of you are applying for. You may have found some private foundations to help defer some of the costs of COVID. And it really comes down to, you have to look at all of those. Most of those are probably not going to follow ASC 470, the debt track. Probably most of those are going to either be grants or they're going to be exchange transactions following 605, 606 grants or revenue recognition. But again, you have to look at each of those instances to determine which way you need to document the way you are recognizing those.
All right. So, in summary, the accounting and the financial reporting, it's not neat. It doesn't fit into the existing GAAP framework all that well. And again, as Jerry said at the beginning, we really got to look at judgment. We got to document what our judgment is, and we got to disclose it. We really need clear and transparent disclosures. And then, as part of reporting to your audit committees and boards, be very clear about what those significant judgments and estimates are. And polling question number 4. Do you know exactly how we are going to record our various sources of funds? So basically, as I just launched this poll, when you got your PPP, FEMA, PRF, other CARES Acts, do you know right now how exactly you're going to record that? A, yes, B, no, or C, you can't wait to discuss it with your audit team? All right. Well, that comes in. We are going to start some of the Q&A of some of the questions that came in. Jeff, I am going to start with you. Where did it go? Under the FTE forgiveness reduction instructions, there are exceptions for various situations, voluntary reductions. Do these exceptions apply to salary and wage reduction calculations?
Yes. and what you're talking about is if you were trying to fill a position and you couldn't, or you had someone leave that reduced your FTEs or your salary costs because of a non-COVID reason. And depending on the circumstances, you can apply that to your FTE calculations as though it is not a reduction, even though you have one fewer person there. Or you can count it as a component of your salary cost that can be applied toward PPP. Most of the time, it's going to be more advantageous to use it in the FTE part of the calculation because your salary costs over 24 weeks are going to far exceed the amount that you need to get all the money spent. But yes, the answer is yes.
Margaret, we have I got a few for you, but let's start with an overriding question we receive a lot. Who is really considered the payer of last resort? HHS, FEMA, somebody else? Is there a pecking order for those claims?
So as of right now, HHS is kind of the payer of last resort. They have explicitly said in the FAQ that FEMA money, for example, should be used before HHS funds. And FEMA is generally considered the payer of last resort. So I think that key line of not reimbursed by other sources or obligated to be reimbursed by other sources is key in that. Some of the things that are a little bit unclear at this moment have to do with timing. So if you've applied for FEMA funds, for example, but you haven't received them yet, that can be kind of a complicating issue. You know, do you have to assume that you're going to get them and remove them from the expenses? You know, what happens if you get them later and you've already used those expenses for HHS? So timing is definitely going to be something to consider as far as how you apply funding.
Okay. Let's see if I have one for Mike that's come in. Does the 50% unemployment credit only go through the third quarter?
No, it goes essentially through the end of the year. December 26th, for whatever reason, is the exact date that they have communicated, though.
Okay. Let's see. Back to Margaret. A residential program and a need that needed technology equipment to help residents attend a school. Is that cost allowable under the Provider Relief Fund?
If it's part of your residential program, then I would say yes. You know, if it was something that you had to purchase because of COVID that you didn't have to purchase before, then I would agree that would be allowable.
Jeff, someone asked for a little clarification on the alternative size standard. Could you maybe give about 1 minute or 2 minutes on just reiterating what you said about the alternative size standard? Because I know this has been a hot topic through when folks were applying for the PPP loan and looking at that 500.
Yeah, there's two parts of this, and the term alternative size standard gets confused with both of them, but it really only applies to one of them. So there's the path where you are using what the SBA calls their alternative size standard. Then there's the path where where you have identified yourself as in an industry where the defined number of employees to be a small business is specifically defined by the SBA for that specific industry. Those are two different things. So a lot of times people are using these industry codes and they're talking about it like it's the alternative size standards, but that's not what that is. Alternative size standards is based on the equity and other balance sheet elements of the organization, and only for-profit entities can use the alternative size standards. And it's based on financial measures on your balance sheet. The number of FTEs and this industry code thing is based on what industry you're in and what the minimum number of employees is for your industry. So if you're going to try to use the industry code, you're talking about the FTE minimum that's defined for that industry. The alternative size standards, again, is not available for nonprofits.
Jeff, could you just comment on the fact that we are aware that in the early stages of PPP approvals, that there are many organizations that have been granted PPP loans that don't necessarily correspond with what you just said?
That is correct. It's very appropriate and totally true to say that there was a lot of confusion about this in April when everyone was trying to apply, and there was a rush to apply because of the fear that the money was going to run out. So people were forging ahead with applications in April when maybe they weren't totally clear on what the eligibility rules were or how they fit into those eligibility rules. And I think that can be forgiven, although that's not the official position of the SBA. However, fast forward to now, 8, 9, 10 months later, when you go to apply for forgiveness, you cannot use that excuse anymore that, oh, there's just so much confusion, I'm just going to apply. So there's an expectation, or I think from a risk standpoint, every PPP borrower should have a plan to document the considerations of eligibility and understand that you have a solid case that's documented before you apply for forgiveness. Because if you apply for forgiveness, you're attesting again to your eligibility, and you would essentially be compounding the problem if, in fact, you are not eligible. So this is why we're still talking about eligibility 9 or 10 months later. It's possible that you got a loan even though you may not have really thought through all the eligibility requirements back in April because of the confusion and the changes in the rules and the rush. You can't say that now that we're 8 or 9 or 10 months later, and because of that, it's time to revisit that if you haven't already.
And if I could just add, everyone I think knows that the congressional stimulus that's being discussed today and maybe passed by midnight tonight has an extension of the PPP loan program built in. There were $268 billion left from the original allocation from the CARES Act. I most recently read that the bill that is currently being discussed, the $900 billion bill, has approximately $300 billion allocated for additional PPP loans. We are hopeful, but I wouldn't necessarily bet on the fact that this legislation or further comments or guidance may provide some additional, if you will, information with respect to those organizations that applied in March, April, May, received PPP loans that technically now are viewed as not having been eligible, and whether or not those original applications will be grandfathered in some way as we go into the second round of PPP.
And if I could just add, I'm sorry, one more comment on that. If it turns out that you're not eligible, the implication there is that you should not apply for forgiveness and that you should plan to pay the loan back. This is not something that anyone wants to hear, so I realize I'm not very popular by saying this, but from a risk standpoint, to get your forgiveness and then find out later, have that through an SBA audit that you never should have gotten the loan in the first place, there's risks there of not only having to pay the money back, but having penalties, interest, et cetera, et cetera. So considering those risks, and I'm not trying to conclude what the ultimate outcome would be for anyone at this point. However, consideration of those risks is prudent at this point.
And one of our attendees just pointed out that they have a legal opinion from a law firm that says that they are eligible under the alternative size standards. We do not know, obviously, the specific facts and circumstances related to that particular organization. But we can tell you that Bonadio has been involved with at least 10 different law firms on this particular topic, and I can tell you that there is a split vote out there in the legal community with respect to how the alternative size standards could or should and were intended to be used in the original CARES Act. And certainly, as Jeff has just said, having documentation to support your position, having a legal opinion from a law firm is certainly good documentation to have. We don't know. We can't ever predict what the response is going to be as you go through loan forgiveness and the banks then have to interact with SBA with respect to the questions that will inevitably come up in that process.
All right. A question came in for myself for clarification. Does it make sense for a nonprofit to include all COVID funding as a liability until you are able to justify that you're eligible for the funds or forgiveness? So kind of going back to the part of my presentation where the accounting guidance says, essentially it says it's binary 0 or 1, but then when you follow it through and say, we're going to have to estimate some of this. So you marry that into what Margaret presented on. I think we all know that there's a healthcare related expenses. You've been coding that to your GL. That's direct. We know exactly that happened. You should be able in a position to recognize that and document it. Then we get a little bit into more of the grayer area of terms that do need to be defined, such as maintaining, in the G&A expenses, such as maintaining healthcare delivery. What exactly does that mean? And then you start thinking, is there an interaction, such as we've been talking to about, is there an interaction between the PPP funds? You can't have what's called the double dip. You can't have an expense reimbursed by two sources, whether it's PPP, your normal Medicaid billing, or a different form of CARES Act. That's the part you're going to be in a position that you have to estimate what do you really think you earn. That's the part when I said that's going to be constrained. So again, I don't think it's all or nothing as a question saying keep it all in the liability. There should be a piece, and we're going to expect a piece of healthcare-related expenses or even lost revenue that you can recognize. The estimation is really that kind of that other piece, and as you look at the big picture as a whole, what can we end up recognizing? All right.
So are you saying to put it in the liability section?
The part that you're not comfortable with, and you document, the question that came in was, would you put the piece you're not comfortable with, would you put it in the liability section? Well, if you sit there and you believe that based on your best estimate as of all the information available to you, and when you look at all your sources of funding, all your sources of income, you get to 12/31, you're extending out the reporting, if you're extending out the reporting date to 6/30, and you can use the funds even further, the HHS guidance comes out, and you put that there, and you're making your best estimate, you can put that into revenue, or you can put that into liability. It's really going to have to be done. I can't sit here for every single organization here today and say what you need to do. It's a facts and circumstances based analysis.
We'll discuss that more.
Yes.
For the CFR report.
Yes.
As well.
That will be discussed as part of the CFR reporting. But this is just to guide what the financial considerations are today. Assistance, as well as information technology, to navigate the CARES Act and other COVID-related funding and reporting, is that an allowable expense under the CARES Act? I'll look to Jeff to answer that one.
It's not an allowable expense directly under PPP. If you have to hire someone and you have payroll costs, and it was during the 24 weeks, that would be eligible under PPP. But hiring an outside consultant is not eligible under PPP. As far as incremental costs under the provider relief funds, I guess I'm not totally sure, but it probably would be eligible.
Yep. I will handle that. Under the provider relief funds, well, Margaret just came back. I will say, though it's not specifically scoped out, additional accounting costs and provider relief would be looked at as an incremental cost related to preparing, preventing, diagnosing, and treating all possible cases of COVID. So yes, the same thing with information technology, especially if that's a directly related healthcare expense. Margaret, would you concur?
I would concur.
All right. All right.
So we're now going to move to Michael Cross, who's with our information technology group, and Michael will be assessing the various risks associated with security, cybersecurity, and it's a big day because all of you know that I think at least 30 to 40 of our federal agencies that think that their networks are impenetrable have been hacked, some of them dating back to March of this year. So I think this is a very, very timely topic for all of us to not become too complacent in terms of just how strong we are. And none of the people that have presented so far, including me being a technical dinosaur, know what to say to you in this area, but Michael certainly does. So Michael, take it away.
Thanks. As stated, my name is Michael Cross. I am a security consultant and penetration tester with Foxpoint Solutions. We are the information risk management component of the Bonadio group. And that's a great place to start is this SolarWinds Orion hack that everyone's been talking about. Over the next couple weeks to couple months, when we finally get a grasp of how big it was, my assumption is that it's going to be probably one of the most significant cybersecurity events in this country, preceding the 2015 hack that happened to the public sector. That being said, a lot of the information that I'm going to cover today is a lot less sophisticated than the hack that occurred against, the DHS, the Nuclear Commission, all sorts of those things. But it's just as important all the same. So what we're going to talk about today, I've kind of broken it down into like 3 parts. I had our attention for about 20 minutes. We're going to talk about some technical considerations, both pre and post-COVID. We'll talk about some legal and regulatory considerations that you should be aware of. And then we'll kind of wrap it up with a discussion of the importance of risk management and how a solid risk management program can effectively deal with both those technical and legal considerations that we talk about. So we're going to kick it off. We're going to start with this discussion of the 2020 Global Security Report. This was issued by Trustwave Security. They're a managed security provider, and it took they're obviously a worldwide managed security provider. And so what this report does is it kind of aggregates information breaches, information security breaches from roughly thousands of locations across 16 countries worldwide. And this is really important because it helps us to kind of quantify a lot of the different types of data, different types of breaches, what sectors are most affected, how these breaches occur, and what types of information are being targeted. 18%, you can see the data on your screen, 18% involved ransomware, up from 4% the previous year. This is a very, very significant jump. And we're going to talk about ransomware in a little bit, probably being one of the most severe threats to any organization right now. But first I want to talk about phishing and social engineering. The number one risk to any organization is the users themselves. So it's imperative that your users are trained, they understand the importance, the role that they play in your organization's cybersecurity, because you can see that about 50% of the breaches that occurred in 2019 were a direct result of a phishing or a social engineering campaign. There's a famous quote that I like that when we talk about security breaches, any security breach can kind of be broken down into one of two scenarios. Someone did something that they weren't supposed to do, or someone didn't do something that they were supposed to do. And when we talk about phishing and social engineering, we're talking about the former. Someone clicked on a link they shouldn't have. Someone downloaded a program they shouldn't have. So understanding the role that literally everybody in the organization plays in securing the network, the information, the overall organizational infrastructure is absolutely important. You can see that the next highest cause of breaches was application exploits at only 11% of the breaches. So far and away, phishing and social engineering is probably the biggest threat to any organization. Talking about ransomware specifically, ransomware is a type of malware that, just as its name suggests, is ransom. What it will do is it'll encrypt your data, and then the malicious actors will reach out to you, and you have to pay a ransom to either get it back or to get it unencrypted. When I say encrypted, I mean you won't be able to access it. If you did access it, it would just be jumbled. You wouldn't be able to do anything with it. So they essentially steal your data, they lock it down, and they force you to pay for it to get it back. All these ransomwares or ransoms are paid using some sort of cyber cryptocurrency like Bitcoin, Ethereum, things like that. These are largely untraceable, so it's incredibly easy for these malicious actors to get away with it. There's no paper trail involved in it, and unfortunately, it's very, very lucrative. You can see at the bottom, there's $64,000 is the average cost of ransomware. That's due to downtime and also due to just paying the ransom itself. The caveat is that is reported and publicly available statistics. If you think about how many organizations just simply paid the ransom and didn't report it because they didn't want to have to, report a breach, things like that, that number is likely tremendously higher. And the unfortunate thing is that there's kind of this malicious synergy between ransomware and social engineering and phishing. And it's kind of, a chicken or the egg scenario. Is ransomware on the rise because, for lack of a better term, people are so gullible and everyone's falling for these phishing campaigns? Or are these phishing attacks and social engineering campaigns on the rise because ransomware is so lucrative and there's so much money to be made in it with relatively little effort or little, technical skill needed by the malicious actor? Unfortunately, the one thing that we do know is that throughout 2019, 2020, and for the foreseeable future, honestly, phishing, social engineering, and ransomware are going to be major, major issues for any organization, any size. So during this year, obviously it goes without saying that COVID really, really interrupted how all how a number of businesses did business. We've made this transition to a remote workforce. With that transition, there's a lot of kind of new technical considerations, new threats that you should be aware of that you probably wouldn't have to have been as worried about if your entire organization did go to a remote workforce. I've got a couple examples of those listed on this slide. We're talking about remote desktops, VPNs, mobile devices, personal devices, things that an organization had to kind of make this quick pivot to allow them to continue business. Under normal conditions, these are not, quick pivots like I just said. Implementing a VPN or a remote infrastructure, that takes time. It should take, upwards of 6 months to a year, to do the risk assessment, to analyze the infrastructure and the technology needs. Unfortunately, with COVID, we didn't have that. So there was a quick turnaround. And what that means is a lot of them might not be a lot of these remote infrastructures might not have been configured as securely as they should have, because quite simply we didn't have time. It was a matter of getting them up and spinning, and then we'll worry about security later. I want to talk about one specific implementation, which is really important to discuss, which is RDP. RDP is Remote Desktop Protocol. It was Microsoft's proprietary protocol, which provides a connection over the internet between two workstations. So you have your computer at home, and then you have your computer at the office. And you're sitting at home through RDP. You connect to your office computer. For all intents and purposes, you're working on that computer. 90% of all ransomware attacks in 2018 were the result of some sort of RDP exploitation. And I want to kind of discuss why RDP is so dangerous. You can see kind of right in on the graph. We'll first talk about the graph on the right. Right in March 10th, 2020. This is worldwide data from Kaspersky, and the graph indicates the number of attacks against the RDP protocol. So March 10th, 2020 is right around when everyone made this transition to the remote workforce. The attacks against RDP almost quadrupled. And they really kind of stayed elevated. It's incredibly dangerous and incredibly critical to understand that the malicious actors, the bad guys, they understand that these organizations made this pivot, and they themselves have made a pivot with their attacks. Specifically with RDP, there's two vulnerabilities that we'll briefly discuss without getting into too much detail. They're called Bluekeep and Deja Vu, and these are actually offensive attacks that were leaked in 2017 by the NSA. These attacks are so critical and so severe that Microsoft actually released patches for old, out-of-date systems all the way back to Windows XP and Windows Server 2003 last year, which is pretty much unheard of. And the reason why that Microsoft took such a drastic step is because the potential for exploitation via RDP is immense. This particular attack is we call it wormable, which means it's self-propagating. If you imagine, a house of cards or dominoes, you kind of only need to push the initial one, and it kind of does the work itself. If you remember, in 2017, there was the global Wannacry attack. This was a very, very similar ransomware attack that affected upwards of 200,000 computers across 150 countries. Conservative estimates say that it costs about hundreds of millions of dollars in damages, but some people have argued that the costs exceed $1 billion in damages. And that was the result of a similar vulnerability in an SMB protocol, but pretty much the bad guys found a vulnerable port in a publicly accessible port. They uploaded their malicious their malware, and it kind of did itself, or did the rest itself. In 2019, Errata Security published a report that there was over 1 million RDP devices or RDP ports publicly accessible, which were vulnerable to this specific vulnerability. So as security researchers, you kind of feel like the scientist at the start of any sci-fi movie who's arguing that an attack's coming, the writing's on the wall, but yet no one's really doing anything about it, as you can kind of see with the amount of vulnerable devices. So I think we got a polling question right now.
All right, everybody, we got the 5th polling question. So I'm going to start now because we noticed there's a delay, so it is up right now. And what is the leading factor of organizational compromises and security breaches? So no right or wrong answers. Well, I mean, there is a right answer, but we're not grading you. It's just we need to have you responding to them. So we have 1 minute left. We have 30 seconds, so for those needing CPE, there's still 151 of you to respond. Here's your 20-second warning. There's 4 of you that were in process, so you got 15 seconds just to hit any button.
Want to do that Saturday Night Live thing where they say before they go live? 5 seconds. Last chance.
There we go.
What are you doing up so late on Saturday night?
Thank you all. I got it recorded.
Yes.
All right.
Michael, you're back.
So, yeah, moving on, the answer was, of course, social engineering and phishing, far and away the number one leading factor for organizational breaches. So moving on from, the technical considerations, I want to briefly talk about some legal considerations or some regulatory considerations. Labor Day of this year, Andrew Cuomo signed into legislation requiring all employers to create plans to, it's mostly to adequately protect workers in the event of, another pandemic, but there are some considerations in these state and assembly bills related to IT, specifically, the specific protocols and technology that are going to enable people to work from home or work remotely from wherever, and then to provide the necessary technology for telecommuting. We're going to talk about those specifically on the next slide, but right now we don't really know anything other than that, or the fact that they need to be finalized by April 1st of next year. The plans are going to apply to state and localities, school districts, municipalities, things like that. So as you're kind of developing these, we'll call them pandemic responses or pandemic plans, it's a great time to take a look at your existing continuity documentation, including your disaster recovery plans and your business continuity plans. Up until COVID, a pandemic might not have been high on the list of things that, to be included in a DRP or a BCP. You can see at the bottom a pandemic versus a natural disaster, which is going to be more commonly included in a disaster recovery plan. There's vast differences in terms of the impact, the duration, the targets, and the threat. So it's a great time to kind of revisit your DRP and your BCP to make sure that they are sufficient and that they adequately address kind of this new pandemic. In addition to that, we have the New York Shield Act. And the New York Shield Act isn't new per se. There's kind of 2 dates that you should be aware of. The first was October of 2019. This updated the breach notification laws. It updated the definition of a breach, what constitutes a breach, what information constitutes a breach, what type of information rather. But there was this data security program, which was the second kind of date that you need to be aware of, which unfortunately landed right in the middle of this kind of transition to this remote workforce in March of this year. So it's not a stretch to say that this might have taken a back burner. And, if it was on your radar in January, February, March, COVID hit and it might have kind of lost its precedence. But all the same, it did need to be implemented March 21st of 2020. And what the rule states is that your organization has to have a data security program in place, and it has to meet these kind of 3 reasonable safeguards. reasonable administrative safeguards, technical safeguards, and physical safeguards. When we talk about reasonable administrative safeguards, we're talking about policies and procedures. Does your organization have a documented procedure for offboarding employees? Getting the information assets back from an employee who left. When we talk about reasonable technical safeguards, we're talking about firewalls, encryption, things like that. And then, do they have reasonable physical safeguards? Locks on doors, cameras in the network security closet. Unfortunately, Shield is incredibly vague beyond that. It doesn't really define what is reasonable, what for an organization of various size. For example, a mom and pop credit union in upstate New York and Chase Manhattan both fall under this exact same rule with the exact same language. So I think it'll be probably another year before we really understand what they mean by reasonable, and we'll see how to kind of audit it. But moving forward, it's imperative that you document everything because I can tell you that in the instances if knock on wood, you do get audited, the first thing that I would assume that they're going to ask for is the documentation of a risk management program and to kind of justify what you say is a reasonable standard or safeguard. So we're going to talk about risk management to kind of and wrap this up and how an effective risk management program can kind of deal with those technical considerations and those legal considerations. We're talking about risk management. We talk about the CIA triad, the confidentiality, integrity, and availability. You want to make sure that your data, your information, your assets, your resources, you can assure the confidentiality of that data, that it's non-public when it needs to be, it's confidential where it needs to be. Only those who have access to it, or only those that need to have access to it, do so. When we talk about the integrity of the data, we're talking about can you validate that it is what it is supposed to be. If you save a database that says 20, when you open it tomorrow, you need to be sure that it's still going to say 20, and that's obviously a super, super simplistic answer there. You want to make sure that you can validate that it is what it is supposed to be. And then availability speaks for itself. If you have an email server, you want to make sure that email or exchange server is available, up and running, and your employees can use email. So we're talking about a risk management program. It's an ongoing process. It's identification of risk, evaluating the risk, and then treating the risk. Are you going to mitigate that risk? Are you going to accept that risk? Are you going to transfer that risk? Or are you just going to avoid that risk? Developing and implementing a risk management program, I guess the first step is kind of finding a security framework. Now, the NIST Cybersecurity framework is widely regarded as the benchmark. This is what we use in our risk assessments. And we use specifically, there's the NIST SP800 series. It's a series of work papers that are specifically, they all deal with various different elements of cybersecurity. But 800-53 is kind of the big one. It includes 20 control families that you kind of go through and you kind of check the box from access management, physical controls, firewalls, passwords, media destruction. There's 20 of them, and each control family includes 5 to 10 specific controls addressing organizational risk. It's an ongoing process, and this is constantly updating these work papers. As you can see, 800-46 revision 2. That's their guide to enterprise telework, remote access, and BYOD security. It's a great work paper to kind of go through if you're unsure of where to begin when kind of implementing a pandemic plan or a remote infrastructure. The key here, though, is that we talk about defense in depth or a layered approach to risk management. Much the same if you think about a car has a seatbelt, a car has an airbag, a car has a reinforced steel chassis. All those work together to protect you in the event of a crash. One of them by itself, it'll help, but it's not going to completely protect you. Just the same when it comes to risk management, there's different layers that an effective risk management program is going to include. It's going to include vulnerability testing, penetration testing. It's going to include risk assessments, and it's going to include risk audits. Now, while all of those kind of sound very similar, they're functionally different. Very, very briefly, a vulnerability scan, it's going to scan your network, your devices. It's going to identify what are the vulnerabilities discovered on your devices, and it's going to tell you how to fix them. Penetration test is going to go much further. A penetration test is going to attempt to exploit those vulnerabilities and really let you know, okay, you have an RDP, one of your servers is vulnerable to Bluekeep. I exploited that. I got root access, and I was able to create a domain admin account for myself and hide it. So, a penetration test really exploits the vulnerabilities and tells you why they are so severe. IT risk assessments is kind of just a point in time snapshot of the risk or your risk environment, I should say. You can't really rely on it for operational effectiveness, but it's a great tool to start if you're kind of developing a risk management program. Starting with a risk assessment is great because it lets you know, all right, this is where our risk is, so now we got to fix it. And then a risk audit is a much more comprehensive risk assessment. This is, whereas a risk assessment is point in time, an audit looks over a period of time. It's going to test specific controls, and you can really rely on it to attest to the operational effectiveness of those controls. So when we talk about defense in depth and a layered approach to risk management, a hypothetical risk management program would include, at minimum, quarterly vulnerability scanning, annual penetration testing. Maybe we're going to do a risk assessment one year, followed by a risk audit the next year, and then we're going to do another risk assessment the following year, but only visit the controls or identified gaps of the previous year's risk audit. And then after that third-year period, we're going to restart and do another risk assessment. So at multiple levels, you're assessing your risk throughout the organization. So just some quick final thoughts. Ransomware and social engineering, biggest cyber threats of 2019, and they will continue into the foreseeable future. COVID necessitated this monumental shift in how we do business, and unfortunately that meant there was some additional risks and technical threats that you definitely need to be aware of. It also meant that there were some new legal considerations, new laws, the Assembly and State bills, New York Shield, that do need to be on your radar. And then lastly, the importance of risk management, how an effective risk management program is going to address those technical considerations, how it's going to address those legal compliance and regulatory considerations, and how it's an ongoing process that really never ends. That being said, I believe I saw two quick questions. I will briefly go over those. The first being that if an email server gets encrypted through ransomware, what do they have in place for crisis communication other than email? There's two of the best ways, or two of the only real ways to address ransomware. First and foremost are going to be backups. Having an effective backup and testing the backup, making sure, unfortunately, some ransomwares do target backups, but having a backup, having all of your critical systems backed up, you test those backups, you know they're good to go. Having an effective backup schedule and a backup infrastructure in place will mean that if that server gets encrypted due to ransomware, you can roll it back. An effective IT team is going to be able to roll that back. You might lose a day, you might lose a week's worth of work, but fortunately, the downtime is going to be much less. The second kind of way to deal with ransomware is keeping everything up to date in terms of patches. There are multiple patches. If you talk about RDP, for example, there are numerous patches available and have been for some time that a vulnerability scan would identify that you can implement to make sure your servers, your infrastructure isn't vulnerable to these types of attacks. Because unfortunately, if you do get hit with a ransomware and your infrastructure is encrypted and you don't have a good backup in place, or God forbid your backups get encrypted, there's really nothing you can do. It's such a bleak kind of assertion there, but it's the stark reality. is that, paying the ransom or accepting the loss are your really only two options. And even in cases where you're paying the ransom, that's not advisable because you don't know if you're going to get your information back. If you get it all back, you don't know how much is going to get back. And even if you pay it, it's still a reportable breach. So the best response is a proactive one, making sure that your backups are good to go and your systems are patched. Using WhatsApp, it all depends on your organization, provided that you've done a risk assessment of that particular technology. Have you assessed the risks of using WhatsApp? Have you assessed the risks of using personal devices, things like that? They're all well and good, but you need to be aware, you need to have a plan in place to kind of pivot to that ancillary technology while your email server gets booted back up. Another question I saw, any reason why China is low or do they not report? That's definitely going to be the reasons that they don't report. There's kind of that veil coming out of the People's Republic of China. So any number you see from China, take it with a grain of salt. I would hardly wager that their numbers are as low as they were reported on that graph.
Thank you very much, Michael. We appreciate your presentation, and I'm sure you've got a lot of people worried for the weekend.
Happy to scare you guys. If anyone, I see some other ones, feel free you can shoot me an email, mcross@foxpointsolutions.com. I'll put that in the chat afterwards, and I can answer any questions while we move on.
Thank you, Michael.
All right. We had a question come in. I'm going to direct to Jeff, but I think really this question really circumferences everything we're talking about today. So for the PPP loan forgiveness application, if you apply for forgiveness based on certain expenses, but then later identify that some of those expenses are covered by the normal Medicaid payments or other provider relief funding, etc., are you able to internally reallocate the PPP fund usage as you finalize the year-end and cost reporting, as long as they meet the criteria of PPP loan forgiveness, or are you advising to hold off on loan forgiveness applications until you're more clear on where all of the various funds are to be used?
That's a great question. And the answer is we are advising everyone who poses this type of question to wait. There is, in certain circles, there seems to be this sense of urgency to get your PPP forgiveness application in and get that done. But really, there's no need to do that. There's no urgent deadline. Remember, the deadline for your forgiveness application on PPP is your 24-week period after you receive the loan back in the spring, plus 10 months after that. And for most people, if your loan happened in April or May, that's putting you out into the third quarter of 2021 when the forgiveness application is actually due. So there's no sense of urgency to get it done by December 31st, 2020. There's no sense of urgency to get it done, early or before your audit is finished for your 12/31/2020 financial statements. You really have the better part of 2021 to get that in, and you cannot be compelled to make payments or do anything else until you actually submit the application or the 10 months expires. Because of the uncertainty around how this is going to interact with other funding streams, we believe it's worthwhile to wait. You can get the whole calculation done and be all set to go, but don't actually submit it until you have more clarity around some of these other questions, like you just asked, in terms of how it interacts with other funding streams. That's our advice.
And we do realize, however, that board members as well as management from both our clients and others that we've spoken with feel a sense of urgency related to December 31 audit presentations in terms of wanting to record, if you will, that loan forgiveness in time to issue the financial statements prior to CFR. But Jeff's advice is our collective advice, recognizing that there may be unique circumstances in some of your situations that would prompt you to want to go through a loan forgiveness calculation or presentation in the first quarter, first 4 or 5 months of 21.
Jeff, in thinking that through, if they've already filed and used those expenses for their loan forgiveness and they're already going through the process and finalizing the process, I think looking at that, I would not change change internally numbers to maximize your reimbursement on your CFR. Because you've already used that expense, changing it from one reporting organization versus another, I think is a problem.
And to your point, Terry, that's a great, by applying for PPP early and not having all these other things kind of totally fleshed out, you're actually increasing the risk that you're going to have a problem later when you do prepare your CFR or do your other cost reporting, and you're going to have a conflict between the different funding streams. So keeping it open and not actually submitting the application to us is the least risky path. It's not that it's without risk, but it's the least risky path.
Our next presenters are Terry Phillips and Mike Ballmer. I've been asked to have Terry speak up a little bit. He seems to be a little bit quiet today, unlike his normal situation.
Unlike my normal?
So, if you would, Terry, we're going to talk about now the double dipping, clawback, and CFR implications of what we've been discussing so far. Terry?
Thank you, Jerry. That was a great segue into the double dipping, clawback, and the CFR reporting. So here's our discussion outline. It hasn't changed much since we did this about 45 days ago. We've gotten a lot of clarity, even in the last week, talking with the state agencies. And I think what I would say the most important thing is they are very focused on both those issues, both the double dipping and the clawback. They also are very focused on making sure that their CFR is following GAAP. All right, and both on a revenue recognition area and also on the expense reporting issues that we see here. And I think as we go through the next 10 to 15 minutes, you're going to see more clarity that we didn't have before. And I think both Mike and I have been working both emails and phone calls. We've had a number of calls with OPWDD, OMH, SED, and the interagency CFR committee to ask questions that we know that are coming up. We are working through really the first round of CFRs now from the 6/30/20 year ends, and that's and we're as we work through those CFRs and we're asking ourselves questions: are we getting the right information? What else do we need? What did we miss in there? So I think that you're going to find that the things that you need to pay attention to is really cost allocations. Things are different than what we've done in the past. You're providing services in different locations. You have been billing retainer days. You have been doing things differently. You have providing things remotely. Well, what is the impact of your cost reporting, and how do I allocate costs? How do I pull costs out of where they were originally reported? A great example of this would be an organization that both has day sites and residential programs. When the governor shut down day sites in the middle of March, there's individuals. Most of the individuals were either redeployed or weren't working. So the question is, where should those costs be recorded? And then we added compound retainer days for people who don't receive their day services from you. So it is complex. Your systems probably were not built for some of the things that we're going to ask you to do. So there's going to be a reasonableness, right? Don't pull your hair out. I don't want you looking like me. So, but we want to walk through that with you. We want to, protect you through this process and give you some good information, and we can go from there. I'm going to turn it over to Mike for the next couple of slides, and I'll do the color commentary, and then he'll come back to me for the end of this. Go ahead, Michael.
Thanks, Terry. So the double dip concept, in many ways, is relatively simple, I think. You simply can't use the same dollar in two places, right? So if you are using John Miller's salary in PPP forgiveness, you can't also claim John Miller's salary for your provider relief funds as part of being part of provider relief. And it's not exclusive to those two places. There's certainly many other areas where you're getting reimbursements, you're getting grants, you have other funding already from New York State or from the federal government. In all of those cases, you have to be thinking about the fact that I can't be double dipping. I can't be taking that same expense in multiple places. So, related to the CFR more specifically on some of these items, it's not any different in many ways. As Terry said, there's many changes, but in many ways, I'd like to think of it as the more things change, the more they stay the same. You still are required to report on your CFR in the same way you always have. However, they do have some additional schedules this year, and there's some new ways you can make allocations if you were not able to make them in the same way as you were before. So if you're reporting programs on your CFR, you still have to report the expenses and the revenues in the same way you always have. And as it notes here, you could potentially have expenses being recorded in 2020 in your financial statements and in your CFR, but that matching revenue may not be recorded until 2021. So if you are taking the debt approach on PPP, for example, and you have not received your notice of forgiveness before the end of 2020, you will be recording that extinguishment of debt, the revenue side of that, in 2021. However, all of your expenses are still going to lie in 2020, of course. You could be taking the 605 grant approach to that, and you could be matching your expenses. Some of you that are on fiscal years could have a split of both of those in a way. You could have some revenue recognized in your fiscal 2020, and the rest of the revenue recognized in fiscal 2021. And the main point here is, as always, the revenue has to follow the expense. So if the expense is in 2020, the revenue has to follow if you are electing to recognize it as a grant. On the other side, if you're recording it as revenue in your financial statements, you're recording it as revenue in your CFR. I guess is the point I want to make. Could the state require something different? We've kind of heard this bounced around very unofficially, that even if you elect to go the debt approach, the state could essentially force you in your CFR to record it as revenue if you reasonably expect that you're going to receive forgiveness on that PPP loan. Again, this is very much just an idea that we had heard bounced around in conversation. That is not the approach they're taking as of this point. As of right now, you follow the accrual basis, you follow GAAP for your CFR just as you do for your financial statements.
So, Mike, on that subject, each state agency has a different reimbursement methodology that is predominant to that organization. OPWDD is a Medicaid rate-based agency. Most of the revenue going out to providers is based on rates. There are some deficit funding, but that is not the vast majority of the funding. The same that was said. SED is a tuition-based organization. However, the difference between OPWDD and SED is SED has offsetting revenues that they look at. So they are really taking a hard look at additional grants and funding that is coming from the federal government. So that is to know. And when we have a mismatch between revenue and expense, they are contemplating how to react to that, and they are reserving their rights to see what happens. The secondary would be OMH and Oasis have a different approach. They're very set saying that we follow GAAP, for the CFR, it's the same as we would do for the financial state purposes. But they notified us of what?
I was going to say, it couldn't even make its way to this slide because we just found out yesterday, and I assume that many of you who have OASIS funding maybe received an email in the last few hours. OMH and Oasis has obviously communicated this. OMH, I don't believe, has of yet, but we have it on good authority. They're going to follow the same path. Those two agencies and those two agencies alone, as of right now, are going to combine your 2020 and 2021 CFRs and look at those on a combined basis. So they're trying to alleviate this issue of where you may have a large surplus or a large deficit in 1 year and the opposite in the next year. They're going to mash those 2 years together and they're going to say, what was your overall surplus or deficit for those 2 years combined?
Again, both those organizations have large contracts coming through counties or direct contracts with providers. So there's a different thought process there that they're trying to alleviate those problems, the underfunding and the overfunding.
Do we have a polling question, John?
Yes. Do you feel comfortable with the new COVID-19 schedules in the CFR? The poll is open. Responses are A, absolutely. B, no way. C, don't have a CFR. D, I can't see what D is because it keeps moving.
You know that Bonadio is there to help you.
Do you know the Bonadio is there to help you? Yes. You have 1 minute left on this poll. Again, no right or wrong answers.
While you're answering, we're roughly 2 hours into this, down to the last hour of our session. We have several more topics that we'd like to discuss, but I think you have a clear appreciation for what I said at the outset of this discussion, which is informing your management team and your board or board leadership of the level of complexity that you all are facing, in addition to what they're aware of the daily, if you will, the daily tornadoes that affect your program services and operations. Is very important in our opinion, for you to communicate thoroughly with those parties as you go through, for those of you that are December 31 year ends, as you go through your December 31 audit processes.
We have 8 seconds left. Carry on.
Our next presenter is Andrea Hagen from our Beacon Solutions Group. Many of you know Andrea, and I would encourage you, as a result of her presentation today, to understand that we do have a service sector subject matter experts in the receivables and billing area. Andrea has a tremendous number of skills and competencies across many, many different programs and insurance companies, et cetera, et cetera. So I want to make sure that everybody has a clear picture, and I think Andrea has some interesting comments here to present to you with respect to what many of you are facing in terms of the problems of New York City and the state of New York and the counties with respect to keeping payments on a timely basis.
You did preempt me, though.
Well, you weren't done that?
We had a couple slides. That's fine.
I'm sorry.
We come back. We'll let you've already introduced the.
All right, go ahead. We'll come back to. I apologize.
Okay. That's okay. The polling question.
We'll come back to Terry and Mike. Andrea?
All right. Well, this year has certainly been very dramatic. In many ways, it's been a lot like a soap opera. In February, we started living what seemed like another world. And we've been socially distancing and wearing our masks so the doctors and the nurses can keep us out of General Hospital. The days of our lives were filled with the young and restless college students returning home for the remainder of the semester, and mothers that have turned into desperate housewives forced to balance working from home and overseeing the remote learning of their school-aged children. And the revenue cycle, frankly, hasn't been any less dramatic. We've had to search for tomorrow to understand and implement the onslaught of billing changes that have been issued. And if providers didn't stay on top of things, they quickly found themselves a world apart from getting reimbursed appropriately. Now let's take a look at a few of the changes that impacted some of the health and human service providers. Opioid treatment programs had 8 new rate codes that were introduced to initiate face-to-face encounters. And of course, in typical fashion, those codes were introduced with retroactive dates, so providers had the pleasure of scrambling to try to figure out how to use those appropriately. In October, OASIS certified programs were given information on influenza vaccinations. Outpatient programs can bill Medicaid and Medicaid managed care plans under their physical health services rate codes. And as a reminder, they want to make sure to bill for the administration of the vaccine as well. And residential treatment programs, they are also able to bill for the vaccine under a separate E&M service if it is included in the plan contract. Providers have access to free vaccines, and depending on where they're located in the state, they have to use the appropriate program to get those free vaccines. Now, thinking about the administration fee, providers may charge a fee for doing the administration, but they can't deny the administration for the inability of a client to pay. They also can't send a client to collections for failure to pay that administration fee. Now, in the OPWDD world, providers have been impacted by a lot of changes since the beginning of the pandemic. The SEMP program, for example, had changes that were in place through mid-October, and those were related to the calculation of time for service delivery. And then those guidances were rescinded and replaced with billable service time being limited to when staff are engaged in the delivery of services or using telehealth technology. Day hab providers had a lot of date-specific modifications and guidances that were issued to them that they needed to try to keep up with. Retainer days were in effect from March through July, and then in April there was flexibility with service duration time. And then in July and August, providers could either use flexibility or the modified program day duration of half and full units, and then in July and August there were minimum billing standards for full and half days. And there is a whole lot more than this going on in the OPWDD world. Frankly, instead of it being as the world turns, it should have been referred to as the head spins. Now, in the OMH world, there were a huge number of guidances that were issued related to telephone and two-way video technology guidances. Modifiers 95 and GT were expanded to include telephonic-only services. In March, clinic programs were also allowed some flexibility with rounding of service time. The temporary time reduction and rounding allowance is in effect through the remainder of the emergency period. And I will note that OMH has done a fantastic job of keeping their website updated with all of their guidances. And so if you are in this world, definitely check it out and use that as a source for your regular checking on what is happening in that OMH world. From a FQHC telehealth perspective, they were issued instructions for January through June, which were then replaced with new instructions as of July, and those are now in effect through at least January 20th. Now, I don't really want to spend too much time thinking about the past, especially since there have been some very important new information recently issued from both Medicare and Medicaid. We have a fair amount of new guiding light that we need to consider, some of which could bring us dark shadows, while others could bring us a brighter day. So, the October 2020 Medicaid update included information that the enacted 2021 budget established a Medicaid prompt payment standard, and as such, liable third-party payers, Medicaid managed plans, had to respond to a written notice of a claim for payment within 60 days. Now, from a provider perspective, that doesn't really change very much since most of our payers paid us within 14 to 45 days anyways. But certainly your revenue cycle team should be made aware of this prompt payment regulation. And as long as they're conducting their accounts receivable follow-up in a timely manner, any delinquent payments from a payer really should be found through their routine AR activities. Now, also in that October 20th Medicaid update, we learned that if Medicaid deems a service is medically necessary and appropriate, responsible third-party payers must accept that and pay the claim. Federal and state law prohibit third parties from denying Medicaid third-party liability claims for administrative or procedural reasons, such as filing limits being extended, claim formatting issues, failure to present the card at the time of service, retrospective reviews that they do of your claims, or for failure to obtain an authorization. Now, we've been instructed that should a third-party payer deny for one of those reasons, it is our obligation to submit an appeal to the payer and that we should cite this October 20 Medicaid update guidance. Now, there's some really big action items with this particular piece of information. You definitely need to notify and educate your revenue cycle team about this change. And you should look at your denial management processes and update them if it's necessary. You should also look at how your zero-fill claims are programmed and how they're being created. And you need to determine if changes are going to be necessary in the programming to prevent claims from automatically dropping to Medicaid after a third-party payer denial. And certainly you don't want to give up on having good front-end and back-end processes just because we now have this new ruling, because you don't want to spend the time to follow up on insurance verification or no authorization denials, or if you billed untimely. Those denials take time, they cost money. So keep your processes flowing well and have good revenue cycle policies in place. The October Medicaid update, it had a lot of information, so it also announced a major change in the way fee-for-service billing is done, which would require providers to continue to bill Medicare or that third-party payer prior to billing Medicaid, but that it also stated that we would soon need to attach an EOB to our Medicaid claims covering services when a patient was eligible under another payer. So for any of you who are thinking, are you kidding me? How are we possibly going to submit EOBs on all of our Medicaid claims? We said the same thing here, and our hearts kind of stopped. But then we had we received an email from eMedNey, their listserv, and it was dated 12/4, which we're going to talk more about that in a minute. So that listserv email at least makes us think that attaching an EOB is not going to be necessary. But I do want to remind you that OMIG could still mandate this in a separate communication. We kind of just have to wait and see at this point. So now going back to that December 4th listserv email, what did it say? Well, it outlined that EOBs and other Medicare and third-party payer supporting documentation needs to be kept by the providers for 6 years. That's really not a problem because we should be keeping our financial records for 7 years anyways. Providers must retain evidence that a claim was denied before seeking reimbursement from Medicaid. Now, there are exceptions for statutorily non-covered Medicare services. So action items here are that you need to make sure that you have a policy or a process for retaining your billing information and retaining proof of prior billing. So look at where are your remittances kept? Are they only available on a clearinghouse that after a certain period of time, they will purge those? Do you have your 835 files saved on a server somewhere? If you have paper remittances, where are those being stored? And can you get to them if you need to for a period of at least 6 years, should Medicaid decide they'd like to do an audit? Another consideration is that some provider types have been operating under the guidance that they could bill once per year, per service, per client to obtain a denial, and then use that proof thereafter going forward for the remainder of the year in order to bill Medicaid under a zero-fill claim. So this listserv email no longer supports that action that some providers have been following. Now this slide gives us some more information about zero fill expectations and the use of CART codes and primary insurance verification. Your action items here are that you need to make sure you have processes that support insurance verification at the time of service, because that will help to support the submission of timely claims to a primary payer. Another action item is that is related to, I don't think our slide advanced, sorry. There we go. Another action item is related to non-enrolled providers. So Medicaid's guidance instructs us that payer denial is needed even when a provider is a non-enrolled or non-participating provider. So for example, this could impact your LMSWs who can't enroll with Medicare. So providers, you should think about, well, would it be appropriate to bill that LMSW under their supervising provider, perhaps with the GY modifier? If that's the case, well, system programming is likely going to be needed. And then for our SNFs, our nursing homes, how would this requirement impact a resident when they're cut from Medicare Part A, for example? Do we still need to bill Medicare with the denial to submit to Medicaid, much in the way that MLTCs tried to make us do early on with the transition to MLTCs? So I did reach out to Darius at Leading Age, and we are working on trying to get clarification from him, and he's working on getting clarification from the state if we're going to have to go back to that archaic method of billing Medicare first before we can bill Medicaid. So then, of course, this slide tells us that they are prepared to start monitoring and reviewing the appropriate use of those zero fill claims. So that's really not a big surprise. Any change is often followed up with an audit or extra monitoring of some kind. So speaking of that extra monitoring, that now leads us to payment error rate measurement audits, or Perm Audits, which Arch mentioned at the beginning of our presentation. So the November 20th Medicaid update indicated that New York, for the fifth time, the last time being in fiscal year 2017, I believe, they are now going to start doing Perm Audits. They have already selected a contractor, and it's called NCI Incorporated. They will be requesting documentation for randomly selected Medicaid and Child Health Plus insurance programs, and that already started back in November. They are looking for claims with dates of service July 1st, 2019 to June 30th, 2020. When we send our records to NCI, we also have to send a copy of them to OMIG because they, of course, don't want to get left out of anything fun that they get to look at. And if you, for whatever reason, fail to respond to the records request, they will just assume that you decided that you were paid an error, and they'll go ahead and pursue recovery for you. So, action items here are, I urge you to assemble an interdepartmental team and develop your response plan. You might also want to have someone in-house review the documentation before it gets submitted. And you can do that and make sure that the documentation meets the expectations and the requirements. You're submitting your records to an auditor and to OMIG, and you certainly don't want to give them the opportunity to find anything else wrong with your documentation or what it is that you're doing in your programs. So we have a polling question next.
All right. Polling question number 8. What is an NYS Medicaid Perm Audit? So were you paying attention? I'll launch the poll, but Andre, you can go to the next slide just to make up some time and talk while the folks answer.
Absolutely. So we have some Medicare evaluation and management changes are going to become effective on January 1st. And these are significant changes. They are a big deal, and they are intended to reduce documentation requirements. So the Medicare fee-for-service conversion factor was reduced, but they increased the work RVUs for evaluation and management services. So in the long run, we'll see an increase in payment for those services. There are new guidelines for new and established patient visits. The lowest level of those new patient visits was actually deleted. There's new requirements for history and examination and medical decision-making documentation. They've issued new timelines they've issued new guidance for time-based coding. They've added a new prolonged service code. And combined, all of these result in significant coding and documentation changes across many different provider types. Now, with regard to the changes in professional scope of practice and supervision, there's three important items here. We will now be able to have certain non-physician practitioners, such as nurse practitioners and physician assistants. They will be able to supervise the performance of diagnostic tests. PTs and OTs will be able to delegate maintenance therapy to a therapy assistant. PT/OTs, speech-language pathologists, and other clinicians who now directly bill Medicare will be able to review and verify rather than re-document information that had already been entered by other clinical staff into that patient medical record. So your action items here, clinical, encoding, and billing staff all need to be educated on these changes, and you should develop a plan for auditing to make sure that the changes are being used appropriately within your programs and your agency. And if you're wondering about Medicare telehealth, what we know is that Medicare telehealth in 2021 has been extended at least through the end of it's the later of the calendar year in which the PHE ends or the end of 2021. There's more services that have been added covering a wider range of provider types. Nursing homes will have the change in frequency of visits from once every 30 days to one visit every 14 days. And then there's also changes to brief online assessments and management services, and they're listed there for you. So again, educate your clinical, coding, and billing staff, develop internal or arrange external audits to make sure that all of these new codes are being used appropriately in your facility or your programs. So I do hope that you have been able to, are able to successfully navigate the challenges we face and that you can have the best of everything. If you've been separated from your family and friends during the pandemic, I hope that you can soon travel to where the heart is, whether that's in Dallas or Santa Barbara or Peyton Place, and that you are able to make the best out of your one life to live.
Andrea, two quick questions. Do you know whether NPI, the contractor that was selected to do the perm audits, are they and have they been involved in perm audits in New York back in 2017 or prior periods that you're aware of?
I'm not familiar with them, Arch, so I don't think that they have been someone that we have been engaged with in the past.
Okay, so going forward, or going back to what I said at the outset, where we had a client that received direct communication from OMIG, apparently OMIG is coordinating in some way with NCI, because the notice to our client about having a perm audit and being selected for it came directly from Colleen Quackenbush at OMIG. So we'll follow up on that. And it also reminded me that the questions that we're not able to get to today, as I said for our October 30th webinar, we will address each of the questions in writing and get that information as well as the slide deck back out to you. So can I change gears here? Mm-hmm. What I'd like to do is have Paul go ahead with his presentation, and then the things that I cut Terry and Mike off from are more relevant to my final comments. So can we go on to Paul, and then we'll come back to Terry and Mike.
Yep. Mm-hmm. So Paul should be good to be ready to go. Is Paul there?
Good question.
You should be.
Yeah, there we go. Sorry, but thank you, everyone. This is Ballmer. I'm from our Bonadio Compliance Solutions Group. I just wanted to briefly give you all an update. Some of you have heard this update on the amendment to the Social Service Law 363D, but it's important to reinforce this amendment and have it at the forefront of your minds as we move forward into 2021. With that being said, so what happened? The Social Service Law 363D was created as part of the Chapter 442 in 2005, requires Medicaid providers develop and implement compliance programs aimed at detecting fraud, waste, and abuse in the Medicaid program. That was followed by the Title 18, Part 521 regulations that define the compliance program requirements. So the regulations kind of follow suit with the law. Part of the law of 2020 in New York State, the Social Service Law 363D was updated and amended. Approved April 1st, 2020. Went largely unnoticed at first, but it has gained momentum now, and I think many people are aware. If you're not, this is great. We want to reinforce these amendments. It went into effect, the law went into effect April 1st, 2020, and we'll get into in a few slides here what some of the highlights we think are involved in those amendments. To note, state-wise, coming up in a couple weeks, fines and penalties associated with this law start January 1st, 2021, for any effectiveness reviews happening after that point. So we'll talk about those fines and penalties. We got a polling question here, so we'll take a break on social service law and dig into this polling question.
Yep. Polling question is open. Has the pandemic impacted your compliance program? It is open. You have a minute and 15 seconds left. Paul, please keep continuing on your presentation while we answer the question.
That's good. So some of the key changes that we've seen, or that we saw in the Social Service Law Amendment, within the original law, we had all sorts of provider types that were mandated to have a corporate compliance program. As you may recall, anyone receiving directly or indirectly $500,000 or more per year of Medicaid revenue, if you receive more than $500,000 per year on a rolling 12-month basis, you're mandated to have a compliance program. And also any Article 16, 31, 28, 32 clinics as well. So in addition to that, with the amendments came the inclusion of managed care companies and managed long-term care companies that are now added to the list. Another change, well, not really a change, but compliance program shall meet the requirements in the law as a condition of payment from medical assistance program. That's key. As some of you may know, the annual certification process for your compliance program to certify that you have an effective compliance program is no longer effective immediately, no longer done on an annual basis in December. It's part of your certification to bill Medicaid as part of your annual process for billing, be able to bill Medicaid. That goes back to and related to your MPI numbers and the enrollment date of your MPI numbers. So some organizations have multiple MPI numbers, and you will need to certify for each one of those MPI numbers on an annual basis based on your anniversary date of enrolling in the Medicaid program. New in the law is that it's now required to designate a compliance committee that reports directly and are accountable to organization's chief executive or other senior management. Many providers, many organizations already have a compliance committee in some form or fashion. Now it's built into the law. Okay, now it's a requirement. Before it was strongly recommended or considered good practice, but but now it's part of the law. Another change, designate a compliance officer who reports directly and is accountable to the organization's chief executive or other senior management. To note here, the removal of where it says employee, designate an employee of a compliance officer, no longer says employee. So designating a compliance officer, where that may impact folks is, the ability potentially to either outsource the compliance officer function or, in some other fashion, have a compliance officer who may not be an employee of the organization. Additionally, lines of confidential communication, whether it's a hotline or Dropbox or whatever it might be, must also be available to first-tier, downstream, and related entities. Now, this isn't defined in the law, so we're kind of waiting for the Medicaid Inspector General, OMIG, to update their regulations to see how they're going to react and what's going to be regulation following that piece or that component. But if you have a hotline, having it available and promoting to these downstream or related entities is now in the law. Routine auditing and monitoring should include internal monitoring and audits, and as appropriate, external audits to evaluate compliance with medical assistance program requirements. And the new component here is overall effectiveness of the compliance program. So that's in the law. You certify that you have an effective compliance program. They've now put in the law that your internal auditing monitoring process, whether it's through internal or external means, you have to assess the overall effectiveness of your compliance program. Training and education annually, part of new hire employee orientation. It has to be part of the new appointment of either the chief executive, managers, or governing body members. That wasn't clearly defined in the past, but now that's part of the law as well. So one of the big things that I really want you to take note of here with these amendments is this slide right here. Fines and penalties are now part of the law for having a compliance program that's deemed not effective. Effective January 1st, 2021, like I said a few slides earlier. First offense, $5,000 a month up to 12 months. Subsequent offenses, $10,000 per month up to 12 months. Now, this is adding teeth behind corporate compliance programs and that effectiveness piece that we talk about so often. How do you determine you have an effective compliance program? What's effective for you may not be effective for others. So, having that defined internally and being able to demonstrate that you are following the law effectively will help mitigate these fines and penalties. But it really is the state really putting some teeth behind these mandatory compliance programs. The other next piece, these two last bullets here, the law is now detailing the self-disclosure process and the overpayment process. So if you identify through your internal auditing and monitoring, or you receive double payments or whatever it might be, if you identify money that you received from the Medicaid program, this process of how to pay that money back is now clearly defined in the law. For those of you who have gone to the OMIG website, we'll see some detailed guidance there, but now we see it clearly defined in the law. Okay, so that's the amendment for the Social Service Law 363G. What's important to note lastly here is to monitor. The law went into effect April 1st, 2020. Keep watch for any updated regulations from the Office of Medicaid Inspector General. We heard last week that they were working on those updates, and hopefully we'll see them soon. But keep monitoring that process, and of course, we at the Bonadio Group will be releasing some info as soon as we hear it and as soon as it's made available. We'll release it out too. That's all I had.
Thank you very much, Paul. We are going back now due to my error earlier by cutting Mike and Terry short. Going back to slide 64.
Is someone left me?
Somebody's doing it.
I am now.
I will encourage you to know that we will be done before 2:30 or at 2:30. So please let's listen to the rest of Terry and Mike's presentation, and then I'm going to wrap things up, and we may have some additional questions. We do have to do a number of polling questions between now and 2:30, so please bear with us on that. Terry, you're on.
All right, we're going to give you 5 quick thoughts for CFR regarding considerations regarding the CARES Act. The first thought is New York State is looking for money. Jerry started that conversation early on. It's obvious that with Oasis and OMH, what they've done, where they've extended a single-year contract to 2-year contracts and trying to capture any clawback they can get in that thought process. Said with their offsetting revenue for their tuition rate base, they will do that. They will. They want to see that all those awards reported on line 79 of the CFR, and they want to see those additional costs. So it's important. OPWDD is really going to be looking at the combat expenses because they know that they can, if you have a surplus there over 5% of your revenue, that they can claw that back. They will, as things become tough for the state, they will push that down to us. So what we're saying here is thoughtfulness, understand what they're trying to do, understand what you can do in accordance with the what really happened, what's reasonable on your cost allocations. You need to follow guidelines, all right? But make sure you're capturing costs in the right spots. You provided services in different locations. So what we're recommending here is understand each program, what services you provided in an IRA, what services you provided remotely. If you have a school program, all right, who was doing those services? Did you redesignate people from DAHAP to the school programs? Did you put people from DAHAP into the IRA? Did you relocate the combat people? You need to understand that, and then you need to, in certain cases, you need to split costs between rehabilitation and combat, or between combat and SED. So understand what those people were doing, understand that it's a pandemic, and that's important. So, Mike?
So a couple of notes just on the new COVID-19 supplemental schedules. There's 2. There's one essentially for SCD, and there's one for everybody else. Oasis, OMH, OPW, and now DOH and OCFS that are also have some programs in the CFR. So the point I want to make clear on this is it's additional. So I kind of underline the additional piece here. So if it is a normal expense of running your programs, it's on CFR 1 and CFR 1 only. If it's an above and beyond expense, something that is explicitly related to COVID-19, it goes into both CFR 1 and the COVID-19 supplemental schedule. There is about, I think, 14 or so pages of instructions for each, the COVID-19 and the COVID-19S, which is the SED schedule in the CFR manual. Again, I've mentioned this before, cost allocation methodologies. There is some new special rules because of COVID. They still want you to follow your normal cost methodologies, the cost allocation methodologies to the extent you can. So you may not have been doing time studies, and that's okay for right now. If you were able to, they want you to use that, of course. But if you weren't able to, you do have some other options available to you. Take a look at Appendix J of the manual, and you will be able to see what those are. The concern over reassignment of staff from one site to another. So you may have used staffing that normally would fall under an SED program in an OPWDD program. For example, those costs should follow where that person really was providing service. So if it was an SED-funded, OMH-funded person, and they were providing help in your ResHab program, for example, they should follow that ResHab. They should be reported in ResHab. The offsetting revenue of PPP, et cetera, related to administrative costs. You should be reporting your administrative costs, of course, where you normally would in CFR 3, if it's a true G&A expense. They want you to allocate those revenues associated with those expenses across the programs, much like you're allocating through the ratio value method the expenses of admin across to the individual programs in CFR 1.
In closing, two things I wanted to say. Number one, we will be having an hour webinar over the next 45 days going over more details in the CFR reporting issues that we've gotten clarification, and so we can prepare you for the 1231. We are just wrapping up the 630 CFRs, and as I said earlier, getting into that. That's important. And then lastly, if you go look at page 67 here, the one thing we did get clarification on this week was reporting guidance on staff who were assigned to programs that did not work, but they were paid a paycheck. So, what we were told, because of the CARES Act, the program was shut down or we went remote, and they really had a debate on this, didn't they, Mike?
Yes, they certainly did.
So, and I felt like that was like a scene from Saturday Night Live. But we'll let that go. But anyways, go ahead.
Oh, the polling question has been open. We have about a minute left, so on a scale of 1 to 5. So just make sure you respond.
Okay, and what I was just saying is we believe that the cost should be incurred in the program that the person was working prior to being laid off, or not prior to stop working. So you're paying them a paycheck. They received a paycheck, but they did not work because of a number of reasons. So, and I think for the most part, we got an agreement from them on that. There might be some pushback from SED, but we want to make sure that you're documenting those hours that you paid for that. And that's it for now. Look for our webinar coming soon to a theater near you.
Sounds good. Thanks, Terry. And Mike, do you want to say anything, John, relative to your poll, or shall I?
We got 13 seconds, but we are going to have to launch 3 polls very quickly. So.
All right. Well, let me just say, well, that one's wrapping up, and then you can launch the next one. As I've said several times in this presentation, this slide deck is intended to be presented to your senior management or your board leadership. I specifically put the last section as something that you could parse off, if you will, or basically take the last, rather than give somebody a 110-page slide deck. You go from the slide, essentially 102, till the end, and this gives a very, very good summary, in my opinion, since I put it together, of what board members and senior management team members should know. Let's do the next polling question, and we'll go from there.
Do we believe we'll have a new stimulus package by Christmas, Inauguration Day, after Inauguration Day, or never? We got 1 minute and 30 seconds left, but we can continue on.
All right, so go to slide 103, next slide. So this was a slide that was prepared by Jeff Paley way back when in, I think it was after March, the first CARES Act, and he's continued to update it. And as I said again, giving somebody a single visual with respect to the complexity, this basically compresses the various stimulus activities, but doesn't begin to touch or scratch the surface with respect to all the issues that we covered in the previous 100 slides. And that's why I feel that this particular slide deck of the last one of all the presentations is something that could very easily be provided to and reviewed by your senior management team and your board or board leadership. Next polling question.
All right. Well, we got to wait for this one to close, so we got 30 seconds.
Okay, so on slide 105, we have touched on many of these topics during the course of the last 2.5 hours, and I think what's most important is the fourth bullet on this particular slide in terms of strategic and scenario planning. First of all, we do believe that if you haven't updated your strategic plan in the last 6 months, which many people didn't have time to do, we believe it is important that your strategic plan be updated during 2021. Because we got so much uncertainty between now and the first 100 days of the Biden administration, I would suggest that somewhere in the 60th to 70th day of the Biden administration might be a good time to launch your update of your strategic plan. Let me give it to John for a polling question.
All right. You'll see a little bit later, Arch makes a Seinfeld reference. So who is your favorite secondary Seinfeld character? Newman, George's dad Frank, Jay Peterman, David Putty, or other?
I'm dating myself with my continued Seinfeld references, but I still like to watch every episode that I've already seen 2 times or 3 times before. But on slide 105, the point I wanted to make is that the 4 legs of the chair that I think every organization that's on this webinar and every essentially tax-exempt organization needs to be fully aware of, you have to have the level of technology sophistication that's going to be expected, particularly as we move into an artificial intelligence environment, and be able to afford that technology. You need to have competent and not clueless, but in touch and, if you will, board and management basically have to be, if you will, in balance with one another with respect to pulling the wagon in the same direction. Telehealth and telemedicine. The economist for the Center for Governmental Research said that COVID has accelerated the utilization of telehealth and telemedicine by 10 years. So those of you that are accustomed to jumping the curve, keep in mind that if we're not in that particular arena right now in any big way, that's going to be a cost associated with the future that you may not be anticipating. And we continue to experience a workforce crisis. We've been in one for basically the last 5 years. The pressure on minimum wage, the current pressures associated with people perhaps not wanting to provide services as frontline employees, particularly in a pandemic environment, the remote working environments that have been created as a result of COVID. The basic premise of that particular bullet is that if you're going into an update of your strategic plan and you are an organization that does not have a secure position with respect to financial viability and sustainability, then you will be asked at some point by the state of New York, either directly or indirectly, to consider affiliation with a larger party and a more secure organization. We've heard from many folks at the state that they are looking for regional provider networks to cover anywhere from 3 to 5 counties in terms of the health and human service arena. They don't have the personnel staff at the state level to be able to continue to monitor and oversee all of the organizations that have been created over the last 50 years. So it may not be what I would consider to be fair. It may be arbitrary in terms of where the state is headed here with respect to these regional networks. They've already created them in the hospital and health system arena, and I believe CFR reporting providers are going to be in much the same situation over the course of the next 3 to 5 years. So, next polling question.
Okay. Do you feel better about the upcoming audit and reporting season than when we started the session? A, absolutely. B, not even a little bit. Or C, you still, yes, but we still have questions.
So, can you go to 107 for me? 106 and 107 are external factors to consider, and I think, again, this has been designed for you to take it and give it to your management team and your board or board leadership, and I think it provides a nice foundation for a discussion that should take place in advance of your update to your strategic plan, which is what's on slide 109. I'll let you, again, I was not intending to necessarily go through the Archibald reality tour that starts on slide 111. Before I talk about the reality tour, I believe we have one last.
Nope, we're done. We got through them all.
All right, so the Archibald reality tour, there's a episode of Seinfeld where Cosmo takes people on a bus, called the Kramer Reality Tour. And so I've adopted that as my predictions for the future. So here you've got 10 predictions for the next 10 years. They are quite disturbing to some people. They're not intended to be disturbing for putting them in writing. But I will say that because we are now approaching 20% of our GDP for the U.S., GDP last year was about $21 trillion, just so you know. 20%, you can do the math. We're essentially a little over $4 trillion being spent on health and human services in the U.S. So as you look at these 10 predictions for the next 10 years, and you consider the impact of artificial intelligence, and if you have read any of the predictions of healthcare futurists, you will know that the baby boom generation, of which I am a proud member, we do not have the resources to give Jerry Archibald 2 shoulders, 2 elbows, 2 wrists, 2 hips, 2 knees, and 2 ankles. Now, would healthcare providers like to do that? In some cases, yes. But I think we are heading towards basically an eligibility that is going to be far more, if you will, structured in both beginning of life and end of life care, and that will be a dramatic societal change from what was discussed in this last election process, most notably by Bernie Sanders with the single-payer system. We have many, many other issues that fall into the very, very complicated aspects of the costs that are incurred to provide supports, medical care services to those that can afford it and those that are less fortunate than many of us on this webinar. So with that, we'll close the webinar. We will be sending out the slide deck, and we will also be providing you with answers to the questions that we were not able to address, including some that we were able to address. And obviously, if you have any questions that you'd like to pose, you know how to get in touch with me because I'm the one that sent out the invitation. And if you want to add any additional questions based on what you've heard today, please send those questions to me, and we will take care of getting those addressed, hopefully early in January. We can send out the slide deck probably early next week. But the questions won't be answered until the early part of January. I want to thank all of our presenters. It is 2:31 p.m. We've kept you a minute over, and we certainly appreciate the tremendous attendance that we've had here today. Thank you all very much. Happy holidays, and stay safe and healthy out there, everybody. Please. Thank you.